Chapter 8. Long-Term Charts. Introduction. Of all the charts utilized by the market technician for forecasting and trading the financial markets, the daily bar chart is by far the most popular. The daily bar chart usually covers a period of only 6 to 9 months. However, because most traders confine their interest to relatively short-term market action, daily bar charts have gained wide acceptance as the primary working tool of the chartist. The average trader's dependence on these daily charts, however, and the preoccupation with short-term market behavior, cause many to overlook a very useful and rewarding area of price charting: the use of weekly and monthly charts for longer-range trend analysis and forecasting. The daily bar chart covers a relatively short period of time in the life of any market. A thorough trend analysis of a market, however, should include some consideration of how the daily market price is moving in relation to its long-range trend structure. To accomplish that task, longer-range charts must be employed. Whereas on the daily bar chart, each bar represents 1 day's price action, on the weekly and monthly charts, each price bar represents 1 week's and 1 month's price action, respectively. The purpose of weekly and monthly charts is to compress price action in such a way that the time horizon can be greatly expanded and much longer time periods can be studied. The importance of longer-range perspective. Long-range price charts provide a perspective on the market trend that is impossible to achieve with the use of daily charts alone. During our introduction to the technical philosophy in Chapter 1, it was pointed out that one of the greatest advantages of chart analysis is the application of its principles to virtually any time dimension, including long-range forecasting. We also addressed the fallacy, espoused by some, that technical analysis should be limited to short-term timing, with longer-range forecasting left to the fundamental analyst. The accompanying charts will demonstrate that the principles of technical analysis, including trend analysis, support and resistance levels, trend lines, percentage retracements, and price patterns, lend themselves quite well to the analysis of long-range price movements. Anyone who is not consulting these longer-range charts is missing an enormous amount of valuable price information. Construction of continuation charts for futures. The average futures contract has a trading life of about 1.5 years before expiration. This limited life feature poses some obvious problems for the technician interested in constructing a long-range chart going back several years. Stock market technicians don't have this problem. Charts are readily available for individual common stocks, and the market averages from the inception of trading. How then does the futures technician construct longer-range charts for contracts that are constantly expiring? The answer is the continuation chart. Now, notice the emphasis on the word continuation. The technique most commonly employed is simply to link a number of contracts together to provide continuity. When one contract expires, another one is used. In order to accomplish this, the simplest method, and the one used by most chart services, is to always use the price of the nearest expiring contract. When that nearest expiring contract stops trading, the next in line becomes the nearest contract and is the one plotted. Other ways to construct continuation charts. The technique of linking prices of the nearest expiring contracts is relatively simple and does solve the problem of providing price continuity. However, there are some problems with that method. Sometimes the expiring contract may be trading at a significant premium or discount to the next contract, and the changeover to the new contract may cause a sudden price drop or jump on the chart. Another potential distortion is the extreme volatility experienced by some spot contracts just before expiration. Futures technicians have devised many ways to deal with these occasional distortions. Some will stop plotting the nearest contract a month or two before it expires to avoid the volatility in the spot month. Others will avoid using the nearest contract altogether and will instead chart the second or third contract. Another method is to chart the contract with the highest open interest on the theory that that delivery month is the truest representation of market value. Continuation charts can also be constructed by linking specific calendar months. For example, a November soybean continuation chart would combine only the historic data provided by each successive year's November soybean contract. This technique of linking specific delivery months was favored by W.D. Gann. Some chartists go even further by averaging the prices of several contracts, or constructing indices that attempt to smooth the changeover by making adjustments in the price premium or discount. The perpetual contract. An innovative solution to the problem of price continuity was developed by Robert Pelletier, president of Commodity Systems, Inc., a commodity and stock data service. CSI, 200 W Palmetto Park Road, Boca Raton, Florida, 33422. called the perpetual contract. Trademark. Perpetual contract is a registered trademark of that firm. The purpose of the perpetual contract is to provide years of futures price history in one continuous time series. That is accomplished by constructing a time series based on a constant forward time period. For example, the series would determine a value 3 months or 6 months into the future. The time period varies and can be chosen by the user. The perpetual contract is constructed by taking a weighted average of 2 futures contracts that surround the time period desired. The value for the perpetual contract is not an actual price, but a weighted average of 2 other prices. The main advantage of the perpetual contract is that it eliminates the need for using only the nearest expiring contract and smooths out the price series by eliminating the distortions that can take place during the transition between delivery months. For chart analysis purposes, the nearest month continuation charts published by chart services are more than adequate. A continuous price series, however, is more useful for backtesting trading systems and indicators. A more complete explanation of ways to construct continuous futures contracts is provided by Greg Morris in Appendix D. Long-term trends dispute randomness. The most striking features of long-range charts is that not only are trends very clearly defined, but that long-range trends often last for years. Imagine making a forecast based on one of these long-range trends and not having to change that forecast for several years. The persistence of long-range trends raises another interesting question that should be mentioned, the question of randomness. While technical analysts do not subscribe to the theory that market action is random and unpredictable, it seems safe to observe that whatever randomness does exist in price action is probably a phenomenon of the very short term. The persistence of existing trends over long periods of time, in many cases for years, is a compelling argument against the claims of random walk theorists that prices are serially independent and that past price action has no effect on future price action. Patterns on charts. Weekly and monthly reversals price patterns appear on the long-range charts, which are interpreted in the same way as on the daily charts. Double tops and bottoms are very prominent on these charts, as are head and shoulder reversals. Triangles, which are usually continuation patterns, are frequently seen. And another pattern that occurs quite frequently on these charts is the weekly and monthly reversal. For example, on the monthly chart, a new monthly high followed by a close below the previous month's close often represents a significant turning point, especially if it occurs near a major support or resistance area. Weekly reversals are quite frequent on the weekly charts. These patterns are the equivalent of the key reversal day on the daily charts, except that on the long-range charts, these reversals carry a great deal more significance. Long-term to short-term charts. It's especially important to appreciate the order in which price charts should be studied in performing a thorough trend analysis. The proper order to follow in chart analysis is to begin with the long range and gradually work to the near term. The reason for this should become apparent as one works with the different time dimensions. If the analyst begins with only the near-term picture, he or she is forced to constantly revise conclusions as more price data is considered. A thorough analysis of a daily chart may have to be completely redone after looking at the long-range charts. By starting with the big picture, going back as far as 20 years, all data to be considered are already included in the chart and a proper perspective is achieved. Once the analyst knows where the market is from a longer range perspective, he or she gradually zeroes in on the shorter term. The first chart to be considered is the 20-year monthly chart. The analyst looks for the more obvious chart patterns, major trend lines, or the proximity of major support or resistance levels. He or she then consults the most recent 5 years on the weekly chart, repeating the same process. Having done that, the analyst narrows his or her focus to the last 6 to 9 months of market action on the daily bar chart, thus going from the macro to the micro approach. If the trader wants to proceed further, intraday charts can then be consulted for an even more microscopic study of recent action. Why should long-range charts be adjusted for inflation? A question often raised concerning long-term charts is whether or not historic price levels seen on the charts should be adjusted for inflation. After all, the argument goes, do these long-range peaks and troughs have any validity if not adjusted to reflect the changes in the value of the US dollar? This is a point of some controversy among analysts. I do not believe that any adjustment is necessary on these long-range charts for a number of reasons. The main reason is my belief that the markets themselves have already made the necessary adjustments. A currency declining in value causes commodities quoted in that currency to increase in value. The declining value of the dollar, therefore, would contribute to rising commodity prices. A rising dollar would cause the price of most commodities to fall. The tremendous price gains in commodity markets during the 1970s and declining prices in the 1980s and 1990s are classic examples of inflation at work. To have suggested during the 1970s that commodity price levels that had doubled and tripled in price should then be adjusted to reflect rising inflation would make no sense at all. The rising commodity markets already were a manifestation of that inflation. Declining commodity markets since the 1980s reflect a long period of disinflation. Should we take the price of gold, which is now worth less than half of its value in 1980, and adjust it to reflect the lower inflation rate? The market has already taken care of that. The final point in this debate goes to the heart of the technical theory, which states that price action discounts everything, even inflation. All financial markets adjust to periods of inflation and deflation and to changes in currency values. The real answer to whether long-range charts should be adjusted for inflation lies in the charts themselves. Many markets fail at historic resistance levels set several years earlier and then bounce off support levels not seen in several years. It's also clear that falling inflation since the early 1980s has helped support bull markets in bonds and stocks. It would seem that those markets have already made their own inflation adjustment. See Figure 8.1. Long-term charts not intended for trading purposes. Long-term charts are not meant for trading purposes. The distinction has to be made between market analysis for forecasting purposes and the timing of market commitments. Long-term charts are useful in the analytical process to help determine the major trend and price objectives. They are not suitable, however, for the timing of entry and exit points and should not be used for that purpose. For that more sensitive task, daily and intraday charts should be utilized. Examples of long-term charts. The following pages contain examples of long-term weekly and monthly charts. Figures 8.2 to 8.12. The drawings on the charts are limited to long-term support and resistance levels, trend lines, percentage retracements, weekly reversals, and an occasional price pattern. Be aware, however, that anything that can be done on a daily chart can also be done on a weekly or monthly. We'll show you later in the book how the application of various technical indicators to these long-term charts is accomplished, and how signals on weekly charts become valuable filters for shorter-term timing decisions. Remember also that semi-log chart scaling becomes more valuable when studying long-range price trends. End of Chapter 8. Chapter 9. Moving Averages. Introduction. The moving average is one of the most versatile and widely used of all technical indicators. Because of the way it is constructed and the fact that it can be so easily quantified and tested, it is the basis for many mechanical trend-following systems in use today. Chart analysis is largely subjective and difficult to test. As a result, chart analysis does not lend itself that well to computerization. Moving average rules, by contrast, can easily be programmed into a computer, which then generates specific buy and sell signals. While two technicians may disagree as to whether a given price pattern is a triangle or a wedge, or whether the volume pattern favors the bull or bear side, moving average trend signals are precise and not open to debate. Let's begin by defining what a moving average is. As the second word implies, it is an average of a certain body of data. For example, if a 10-day average of closing prices is desired, the prices for the last 10 days are added up, and the total is divided by 10. The term moving is used because only the latest 10 days prices are used in the calculation. Therefore, the body of data to be averaged, the last 10 closing prices, moves forward with each new trading day. The most common way to calculate the moving average is to work from the total of the last 10 days closing prices. Each day, the new close is added to the total, and the close 11 days back is subtracted. The new total is then divided by the number of days, 10. See Figure 9.1a. The above example deals with a simple 10-day moving average of closing prices. There are, however, other types of moving averages that are not simple. There are also many questions as to the best way to employ the moving average. For example, how many days should be averaged? Should a short-term or a long-term average be used? Is there a best moving average for all markets or for each individual market? Is the closing price the best price to average? Would it be better to use more than one average? There are many questions to be considered when using moving averages. We'll address many of these questions in this chapter and show examples of some of the more common usages of the moving average. The moving average, a smoothing device with a time lag. The moving average is essentially a trend-following device. Its purpose is to identify or signal that a new trend has begun or that an old trend has ended or reversed. Its purpose is to track the progress of the trend It might be viewed as a curving trend line. It does not, however, predict market action in the same sense that standard chart analysis attempts to do. The moving average is a follower, not a leader. It never anticipates, it only reacts. The moving average follows a market and tells us that a trend has begun, but only after the fact. The moving average is a smoothing device. By averaging the price data, a smoother line is produced, making it much easier to view the underlying trend. By its very nature, however, the moving average line also lags the market action. A shorter moving average, such as a 20-day average, would hug the price action more closely than a 200-day average. The time lag is reduced with the shorter averages, but can never be completely eliminated. Shorter-term averages are more sensitive to the price action, whereas longer-range averages are less sensitive. In certain types of markets, it is more advantageous to use a shorter average and, at other times, a longer and less sensitive average proves more useful. See Figure 9.1b. Which prices to average? We have been using the closing price in all of our examples so far. However, while the closing price is considered to be the most important price of the trading day and the price most commonly used in moving average construction, the reader should be aware that some technicians prefer to use other prices. Some prefer to use a midpoint value, which is arrived at by dividing the day's range by 2. Others include the closing price in their calculation by adding the high, low, and closing prices together and dividing the sum by 3. Still others prefer to construct price bands by averaging the high and low prices separately. The result is two separate moving average lines that act as a sort of volatility buffer or neutral zone. Despite these variations, the closing price is still the price most commonly used for moving average analysis and is the price that we'll be focusing most of our attention on in this chapter. The simple moving average. The simple moving average, or the arithmetic mean, is the type used by most technical analysts, but there are some who question its usefulness on 2 points. The first criticism is that only the period covered by the average, the last 10 days for example, is taken into account. The second criticism is that the simple moving average gives equal weight to each day's price. In a 10-day average, the last day receives the same weight as the first day in the calculation. Each day's price is assigned a 10% weighting. In a 5-day average, each day would have an equal 20% weighting. Some analysts believe that a heavier weighting should be given to the more recent price action. The linearly weighted moving average. In an attempt to correct the weighting problem, some analysts employ a linearly weighted moving average. In this calculation, the closing price of the 10th day, in the case of a 10-day average, would be multiplied by 10, the 9th day by 9, the 8th day by 8, and so on. The greater weight is therefore given to the more recent closings. The total is then divided by the sum of the multipliers, 55 in the case of the 10-day average, 10 plus 9 plus 8 plus 1. However, the linearly weighted average still does not address the problem of including only the price action covered by the length of the average itself. The exponentially smoothed moving average. This type of average addresses both of the problems associated with the simple moving average. First, the exponentially smoothed average assigns a greater weight to the more recent data. Therefore, it is a weighted moving average. But while it assigns lesser importance to past price data, it does include in its calculation all of the data in the life of the instrument. In addition, the user is able to adjust the weighting to give greater or lesser weight to the most recent day's price. This is done by assigning a percentage value to the last day's price, which is added to a percentage of the previous day's value. The sum of both percentage values adds up to 100. For example, the last day's price could be assigned a value of 10%, 0.10, which is added to the previous day's value of 90%, 0.90. That gives the last day 10% of the total weighting. That would be the equivalent of a 20-day average. By giving the last day's price a smaller value of 5%, 0.05, lesser weight is given to the last day's data, and the average is less sensitive. That would be the equivalent of a 40-day moving average. See Figure 9.2. The computer makes this all very easy for you. You just have to choose the number of days you want in the moving average, 10, 20, 40, etc. Then select the type of average you want, simple, weighted, or exponentially smoothed. You could also select as many averages as you want, 1, 2, or 3. The use of one moving average. The simple moving average is the one most commonly used by technicians and is the one that we'll be concentrating on. Some traders use just one moving average to generate trend signals. The moving average is plotted on the bar chart in its appropriate trading day, along with that day's price action. When the closing price moves above the moving average, a buy signal is generated. A sell signal is given when prices move below the moving average. For added confirmation, some technicians also like to see the moving average line itself turn in the direction of the price crossing. See Figure 9.3. If a very short-term average is employed, a 5 or 10-day, the average tracks prices very closely, and several crossings occur. This action can be either good or bad. The use of a very sensitive average produces more trades, with higher commission costs, and results in many false signals, whipsaws. If the average is too sensitive, some of the short-term random price movement, or noise, activates bad trend signals. While the shorter average generates more false signals, it has the advantage of giving trend signals earlier in the move. It stands to reason that the more sensitive the average, the earlier the signals will be. So there is a trade-off at work here. The trick is to find the average that is sensitive enough to generate early signals, but insensitive enough to avoid most of the random noise. See Figure 9.4. Let's carry the above comparison a step further. While the longer average performs better while the trend remains in motion, it gives back a lot more when the trend reverses. The very insensitivity of the longer average, the fact that it trailed the trend from a greater distance, which kept it from getting tangled up in short-term corrections during the trend, works against the trader when the trend actually reverses. Therefore, we'll add another corollary here. The longer averages work better as long as the trend remains in force, but a shorter average is better when the trend is in the process of reversing. It becomes clearer, therefore, that the use of one moving average alone has several disadvantages. It is usually more advantageous to employ two moving averages. How to use two averages to generate signals. This technique is called the double crossover method. This means that a buy signal is produced when the shorter average crosses above the longer. For example, two popular combinations are the 5 and 20-day averages and the 10 and 50-day averages. In the former, a buy signal occurs when the 5-day average crosses above the 20, and a sell signal when the 5-day moves below the 20. In the latter example, the 10-day crossing above the 50 signals an uptrend, and a downtrend takes place with the 10 slipping under the 50. This technique of using two averages together lags the market a bit more than the use of a single average, but produces fewer whipsaws. See Figures 9.5 and 9.6. The use of three averages, or the triple crossover method. That brings us to the triple crossover method. The most widely used triple crossover system is the popular 9th of April 18-day moving average combination. The 4th of September 18 method is used mainly in futures trading. This concept was first mentioned by R.C. Allen in his 1972 book, How to Build a Fortune in Commodities, and again later in a 1974 work by the same author, How to Use the 4-day, 9-day, and 18-day moving averages to earn larger profits from commodities. The 4th of September 18-day system is a variation on the 5, 10, and 20-day moving average numbers, which are widely used in commodity circles. Many commercial chart services publish the 4th of September 18-day moving averages. Many charting software packages use the 4th of September 18-day combination as their default values when plotting three averages. How to use the 4th of September 18-day moving average system. It's already been explained that the shorter the moving average, the closer it follows the price trend. It stands to reason then that the shortest of the three averages, the 4-day, will follow the trend most closely, followed by the 9-day and then the 18. In an uptrend, therefore, the proper alignment would be for the 4-day average to be above the 9-day, which is above the 18-day average. In a downtrend, the order is reversed, and the alignment is exactly the opposite. That is, the 4-day would be the lowest, followed by the 9-day, and then the 18-day average. See Figures 9.7ab. A buying alert takes place in a downtrend when the 4-day crosses above both the 9 and the 18. A confirmed buy signal occurs when the 9-day then crosses above the 18. This places the 4-day over the 9-day, which is over the 18-day. Some intermingling may occur during corrections or consolidations, but the general uptrend remains intact. Some traders may take profits during the intermingling process, and some may use it as a buying opportunity. There is obviously a lot of room for flexibility here in applying the rules, depending on how aggressively one wants to trade. When the uptrend reverses to the downside, the first thing that should take place is that the shortest and most sensitive average the 4-day, dips below the 9-day and the 18-day. This is only a selling alert. Some traders, however, might use that initial crossing as reason enough to begin liquidating long positions. Then, if the next longer average, the 9-day, drops below the 18-day, a confirmed sell-short signal is given. Moving average envelopes. The usefulness of a single moving average can be enhanced by surrounding it with envelopes. Percentage envelopes can be used to help determine when a market has gotten overextended in either direction. In other words, they tell us when prices have strayed too far from their moving average line. In order to do this, the envelopes are placed at fixed percentages above and below the average. Shorter-term traders, for example, often use 3% envelopes around a simple 21-day moving average. When prices reach one of the envelopes, 3% from the average, the short-term trend is considered to be overextended. For long-range analysis, some possible combinations include 5% envelopes around a 10-week average, or a 10% envelope around a 40-week average. See figures 9.8 AB. Bollinger Bands. This technique was developed by John Bollinger. Two trading bands are placed around a moving average similar to the envelope technique, except that Bollinger Bands are placed 2 standard deviations above and below the moving average, which is usually 20 days. Standard deviation is a statistical concept that describes how prices are dispersed around an average value. Using 2 standard deviations ensures that 95% of the price data will fall between the 2 trading bands. As a rule, prices are considered to be overextended on the upside, overbought, when they touch the upper band. They are considered overextended on the downside, oversold, when they touch the lower band. See figures 9.9 AB. Using Bollinger Bands as targets. The simplest way to use Bollinger Bands is to use the upper and lower bands as price targets. In other words, if prices bounce off the lower band and cross above the 20-day average, the upper band becomes the upper price target. A crossing below the 20-day average would identify the lower band as the downside target. In a strong uptrend, prices will usually fluctuate between the upper band and the 20-day average. In that case, a crossing below the 20-day average warns of a trend reversal to the downside. Bandwidth measures volatility. Bollinger Bands differ from envelopes in one major way. Whereas the envelopes stay a constant percentage width apart, Bollinger Bands expand and contract based on the last 20 days' volatility. During a period of rising price volatility, the distance between the 2 bands will widen. Conversely, during a period of low market volatility, the distance between the 2 bands will contract. There is a tendency for the bands to alternate between expansion and contraction. When the bands are unusually far apart, that is often a sign that the current trend may be ending. When the distance between the 2 bands has narrowed too far, that is often a sign that a market may be about to initiate a new trend. Bollinger Bands can also be applied to weekly and monthly price charts by using 20 weeks and 20 months instead of 20 days. Bollinger Bands work best when combined with overbought/oversold oscillators that are explained in the next chapter. See Appendix A for additional band techniques. Centering the average. The more statistically correct way to plot a moving average is to center it. That means to place it in the middle of the time period it covers. A 10-day average, for example, would be placed 5 days back. A 20-day average would be plotted 10 days back in time. Centering the average, however, has the major flaw of producing much later trend change signals. Therefore, moving averages are usually placed at the end of the time period covered instead of the middle. The centering technique is used almost exclusively by cyclic analysts to isolate underlying market cycles. Moving averages tied to cycles. Many market analysts believe that time cycles play an important role in market movement. Because these time cycles are repetitive and can be measured, it is possible to determine the approximate times when market tops or bottoms will occur. Many different time cycles exist simultaneously, from a short-term 5-day cycle to Kondratiev's long 54-year cycle. We'll delve more into this fascinating branch of technical analysis in Chapter 14. The subject of cycles is introduced here only to make the point that there seems to be a relationship between the underlying cycles that affect a certain market and the correct moving averages to use. In other words, the moving averages can be adjusted to fit the dominant cycles in each market. There appears to be a definite relationship between moving averages and cycles. For example, the monthly cycle is one of the best-known cycles operating throughout the commodity markets. A month has 20 to 21 trading days. Cycles tend to be related to their next longer and shorter cycles harmonically, or by a factor of 2. That means that the next longer cycle is double the length of a cycle, and the next shorter cycle is half its length. The monthly cycle, therefore, may explain the popularity of the 5, 10, 20, and 40-day moving averages. The 20-day cycle measures the monthly cycle. The 40-day average is double the 20-day. The 10-day average is half of 20, and the 5-day average is half again of 10. Many of the more commonly used moving averages, including the 4, 9, and 18-day averages, which are derivatives of 5, 10, and 20, can be explained by cyclic influences and the harmonic relationships of neighboring cycles. Incidentally, the 4-week cycle may also help explain the success of the 4-week rule, covered later in the chapter, and its shorter counterpart, the 2-week rule. Fibonacci numbers used as moving averages. We'll cover the Fibonacci number series in the chapter on Elliott wave theory. However, I'd like to mention here that this mysterious series of numbers, such as 13, 21, 34, 55, and so on, seem to lend themselves quite well to moving average analysis. This is true not only of daily charts, but for weekly charts as well. The 21-day moving average is a Fibonacci number. On the weekly charts, the 13-week average has proven valuable in both stocks and commodities. We'll postpone a more in-depth discussion of these numbers until Chapter 13. Moving averages applied to long-term charts. The reader should not overlook using this technique in longer-range trend analysis. Longer-range moving averages, such as 10 or 13 weeks, in conjunction with the 30 or 40-week average, have long been used in stock market analysis, but haven't been given as much attention in the futures markets. The 10 and 40-week moving averages can be used to help track the primary trend on weekly charts for futures and stocks. See Figure 9.10. Some pros and cons of the moving average. One of the great advantages of using moving averages, and one of the reasons they are so popular as trend-following systems, is that they embody some of the oldest maxims of successful trading. They trade in the direction of the trend. They let profits run and cut losses short. The moving average system forces the user to obey those rules by providing specific buy and sell signals based on those principles. Because they are trend-following in nature, however, moving averages work best when markets are in a trending period. They perform very poorly when markets get choppy and trade sideways for a period of time, and that might be a third to a half of the time. The fact that they do not work that well for significant periods of time, however, is one very compelling reason why it is dangerous to rely too heavily on the moving average technique. In certain trending markets, the moving average can't be beat. Just switch the program to automatic. At other times, a non-trending method like the overbought-oversold oscillator is more appropriate. In Chapter 15, we'll show you an indicator called ADX that tells you when a market is trending and when it is not, and whether the market climate favors a trending moving average technique or a non-trending oscillator approach. Moving averages as oscillators. One way to construct an oscillator is to compare the difference between two moving averages. The use of two moving averages in the double crossover method, therefore, takes on greater significance and becomes an even more useful technique. We'll see how this is done in Chapter 10. One method compares two exponentially smoothed averages. That method is called moving average convergence divergence, MACD. It is used partially as an oscillator. Therefore, we'll postpone our explanation of that technique until we deal with the entire subject of oscillators in Chapter 10. The moving average applied to other technical data. The moving average can be applied to virtually any technical data or indicator. It can be used on open interest and volume figures, including on balance volume. The moving average can be used on various indicators and ratios. It can be applied to oscillators as well. The weekly rule. There are other alternatives to the moving average as a trend-following device. One of the best known and most successful of these techniques is called the weekly price channel, or simply the weekly rule. This technique has many of the benefits of the moving average, but is less time-consuming and simpler to use. With the improvements in computer technology over the past decade, A considerable amount of research has been done on the development of technical trading systems. These systems are mechanical in nature, meaning that human emotion and judgment are eliminated. These systems have become increasingly sophisticated. At first, simple moving averages were utilized. Then, double and triple crossovers of the averages were added. The averages were then linearly weighted and exponentially smoothed. These systems are primarily trend following, which means their purpose is to identify and then trade in the direction of an existing trend. With the increased fascination with fancier and more complex systems and indicators, however, there has been a tendency to overlook some of the simpler techniques that continue to work quite well and have stood the test of time. We're going to discuss one of the simplest of these techniques, the weekly rule. In 1970, a booklet entitled The Trader's Notebook was published by Dunn & Hargett's Financial Services in Lafayette, Indiana. The best-known commodity trading systems of the day were computer-tested and compared. The final conclusion of all that research was that the most successful of all the systems tested was the 4-week rule. Developed by Richard Donchian, Mr. Donchian has been recognized as a pioneer in the field of commodity trend trading using mechanical systems. In 1983, Managed Account Reports chose Donchian as the first recipient of the Most Valuable Performer Award for outstanding contributions to the field of futures money management, and presents the Donchian Award to other worthy recipients. More recent work done by Louis Lukacs, former research director at Dunn & Hargett, and currently president of Wizard Trading, a Massachusetts CTA, supports the earlier conclusions that breakout, or channel, systems similar to the weekly rule continue to show superior results. Lukacs et al. Asterisk. Of the 12 systems tested from 1975 to 84, only 4 generated significant profits. Of those 4, 2 were channel breakout systems, and 1 was a dual moving average crossover system. A later article by Luca Breck and Borson in the Financial Review, November 1990, published the results of a more extensive study done on data from 1976 to 86 that compared 23 technical trading systems. Once again, channel breakouts and moving average systems came out on top. Luca Wallach finally concluded that a channel breakout system was his personal choice as the best starting point for all technical trading system testing and development. The 4-week rule. The 4-week rule is used primarily for futures trading. The system based on the 4-week rule is simplicity itself. 1. Cover short positions and buy long whenever the price exceeds the highs of the 4 preceding full calendar weeks. 2. Liquidate long positions and sell short whenever the price falls below the lows of the 4 preceding full calendar weeks. The system, as it is presented here, is continuous in nature, which means that the trader always has a position, either long or short. As a general rule, continuous systems have a basic weakness. They stay in the market and get whipsawed during trendless market periods. It's already been stressed that trend-following systems do not work well when markets are in these sideways or trendless phases. The 4-week rule can be modified to make it non-continuous. This can be accomplished by using a shorter time span, such as a 1 or 2-week rule for liquidation purposes. In other words, a 4-week breakout would be necessary to initiate a new position, but a 1 or 2-week signal in the opposite direction would warrant liquidation of the position. The trader would then remain out of the market until a new 4-week breakout is registered. The logic behind the system is based on sound technical principles. The signals are mechanical and clear-cut. Because it is trend following, it virtually guarantees participation on the right side of every important trend. It is also structured to follow the often quoted maxim of successful trading: let profits run while cutting losses short. Another feature, which should not be overlooked, is that this method tends to trade less frequently, so that commissions are lower. Another plus is that the system can be implemented with or without the aid of a computer. The main criticism of the weekly rule is the same one leveled against all trend-following approaches, namely, that it does not catch tops or bottoms. But what trend-following system does? The important point to keep in mind is that the 4-week rule performs at least as well as most other trend-following systems, and better than many, but has the added benefit of incredible simplicity. Adjustments to the 4-week rule. Although we're treating the 4-week rule in its original form, there are many adjustments and refinements that can be employed. For one thing, The rule does not have to be used as a trading system. Weekly signals can be employed simply as another technical indicator to identify breakouts and trend reversals. Weekly breakouts can be used as a confirming filter for other techniques, such as moving average crossovers. 1 or 2 week rules function as excellent filters. A moving average crossover signal could be confirmed by a 2-week breakout in the same direction in order for a market position to be taken. Shorten or lengthen time periods for sensitivity. The time period employed can be expanded or compressed in the interests of risk management and sensitivity. For example, the time period could be shortened if it is desirable to make the system more sensitive. In a relatively high-priced market, where prices are trending sharply higher, a shorter time span could be chosen to make the system more sensitive. Suppose, for example, that a long position is taken on a 4-week upside breakout with a protective stop placed just below the low of the past 2 weeks. If the market has rallied sharply and the trader wishes to trail the position with a closer protective stop, a 1-week stop-out point could be used. In a trading range situation, where a trend trader would just as soon stay on the sidelines until an important trend signal is given, the time period could be expanded to 8 weeks. This would prevent taking positions on shorter-term and premature trend signals. The 4-week rule tied to cycles. Earlier in the chapter, reference was made to the importance of the monthly cycle in commodity markets. A 4-week or 20-day trading cycle is a dominant cycle that influences all markets. This may help explain why the 4-week time period has proven so successful. Notice that mention was made of 1, 2, and 8-week rules. The principle of harmonics in cyclic analysis holds that each cycle is related to its neighboring cycles, next longer and next shorter cycles, by 2. In the previous discussion of moving averages, it was pointed out how the monthly cycle and harmonics explain the popularity of the 5, 10, 20, and 40-day moving averages. The same time periods hold true in the realm of weekly rules. Those daily numbers translated into weekly time periods are 1, 2, 4, and 8 weeks. Therefore, adjustments to the 4-week rule seem to work best when the beginning number, 4, is divided or multiplied by 2. To shorten the time span, go from 4 to 2 weeks. If an even shorter time span is desired, go from 2 to 1. To lengthen, go from 4 to 8. Because this method combines price and time, there's no reason why the cyclic principle of harmonics should not play an important role. The tactic of dividing a weekly parameter by 2 to shorten it, or doubling it to lengthen it, does have cycle logic behind it. The 4-week rule is a simple breakout system. The original system can be modified by using a shorter time period, a 1 or 2 week rule for liquidation purposes. If the user desires a more sensitive system, a 2-week period can be employed for entry signals. Because this rule is meant to be simple, it is best addressed on that level. The 4-week rule is simple, but it works. Charting packages allow you to plot price channels above and below current prices to spot channel breakouts. Price channels can be used on daily, weekly, or monthly charts. See figures 9.11 and 9.12 to optimize OR0. The first edition of this book included the results of extensive research produced by Merrill Lynch, which published a series of studies on computerized trading techniques applied to the futures markets from 1978 to 82. Extensive testing of various moving average and channel breakout parameters was performed to find the best possible combinations in each futures market. The Merrill Lynch researchers produced a different set of optimized indicator values for each market. Most charting packages allow you to optimize systems and indicators. Instead of using the same moving average in all markets, for example, you could ask the computer to find the moving average or moving average combinations that have worked the best in the past for that market. That could also be done for daily and weekly breakout systems, and virtually all technical indicators included in this book. Optimization allows technical parameters to adapt to changing market conditions. Some argue that optimization helps their trading results, and others that it doesn't. The heart of the debate centers on how the data is optimized. Researchers stress that the correct procedure is to use only part of the price data to choose the best parameters, and another portion to actually test the results. Testing the optimized parameters on out-of-sample price data helps ensure that the final results will be closer to what one might experience from actual trading. The decision to optimize or not is a personal one. Most evidence, however, suggests that optimization is not the holy grail some think it to be. I generally advise traders following only a handful of markets to experiment with optimization. Why should treasury bonds or the German mark have the exact same moving averages as corn or cotton? Stock market traders are a different story. Having to follow thousands of stocks argues against optimizing. If you specialize in a handful of markets, try optimizing everyone. If you're a generalist who follows a large number of markets, use the same technical parameters for all of them. Summary. We've presented a lot of variations on the moving average approach. Let's try to simplify things a bit. Most technicians use a combination of two moving averages. Those two averages are usually simple averages. Although exponential averages have become popular, there's no real evidence to prove that they work any better than the simple average. The most commonly used daily moving average combinations in futures markets are 4 and 9, 9 and 18, 5 and 20, and 10 and 40. Stock traders rely heavily on a 50-day or 10-week moving average. For longer-range stock market analysis, popular weekly moving averages are 30 and 40 weeks, or 200 days. Bollinger Bands make use of 20-day and 20-week moving averages. The 20-week average can be converted to daily charts by utilizing a 100-day average, which is another useful moving average. Channel breakout systems work extremely well in trending markets and can be used on daily, weekly, and monthly charts. The adaptive moving average. One of the problems encountered with the moving average is choosing between a fast or a slow average. While one may work better in a trading range market, the other may be preferable in a trending market. The answer to the problem of choosing between the two may lie with an innovative approach called the adaptive moving average. Perry Kaufman presents this technique in his book, Smarter Trading. The speed of Kaufman's adaptive moving average automatically adjusts to the level of noise or volatility in a market. The AMA moves more slowly when markets are trending sideways, but then moves more swiftly when the market is trending. That avoids the problem of using a faster moving average and getting whipsawed more frequently during a trading range, and using a slower average that trails too far behind a market when it is trending. Kaufman does that by constructing an efficiency ratio that compares price direction with the level of volatility. When the efficiency ratio is high, there is more direction than volatility, favoring a faster average. When the ratio is low, there's more volatility than direction, favoring a slower average. By incorporating the efficiency ratio, the AMA automatically adjusts to the speed most suitable for the current market. Alternatives to the moving average. Moving averages don't work all of the time. They do their best work when the market is in a trending phase. They're not very helpful during trendless periods when prices trade sideways. Fortunately, there's another class of indicator that performs much better than the moving average during those frustrating trading ranges. They're called oscillators, and we'll explain them in the next chapter. End of Chapter 9. Chapter 10. Oscillators and Contrary Opinion. Introduction. In this chapter, we're going to talk about an alternative to trend-following approaches, the oscillator. The oscillator is extremely useful in non-trending markets where prices fluctuate in a horizontal price band or trading range, creating a market situation where most trend-following systems simply don't work that well. The oscillator provides the technical trader with a tool that can enable him or her to profit from these periodic sideways and trendless market environments. The value of the oscillator is not limited to horizontal trading ranges, however. Used in conjunction with price charts during trending phases, the oscillator becomes an extremely valuable ally by alerting the trader to short-term market extremes, commonly referred to as overbought or oversold conditions. The oscillator can also warn that a trend is losing momentum before that situation becomes evident in the price action itself. Oscillators can signal that a trend may be nearing completion by displaying certain divergences. We'll begin by explaining first what an oscillator is and the basis for its construction and interpretation. We'll then discuss the meaning of momentum and its implications for market forecasting. Some of the more common oscillator techniques will be presented from the very simple to the more complicated. The important question of divergence will be covered. We'll touch on the value of coordinating oscillator analysis with underlying market cycles. Finally, we'll discuss how oscillators should be used as part of the overall technical analysis of a market. Oscillator usage in conjunction with trend. The oscillator is only a secondary indicator in the sense that it must be subordinated to basic trend analysis. As we go through the various types of oscillators used by technicians, the importance of trading in the direction of the overriding market trend will be constantly stressed. The reader should also be aware that there are times when oscillators are more useful than at others. For example, near the beginning of important moves, oscillator analysis isn't that helpful and can even be misleading. Toward the end of market moves, however, oscillators become extremely valuable. We'll address these points as we go along. Finally, No study of market extremes would be complete without a discussion of contrary opinion. We'll talk about the role of the contrarian philosophy and how it can be incorporated into market analysis and trading. Interpretation of oscillators. While there are many different ways to construct momentum oscillators, the actual interpretation differs very little from one technique to another. Most oscillators look very much alike. They are plotted along the bottom of the price chart and resemble a flat horizontal band. The oscillator band is basically flat, while prices may be trading up, down, or sideways. However, the peaks and troughs in the oscillator coincide with the peaks and troughs on the price chart. Some oscillators have a midpoint value that divides the horizontal range into two halves, an upper and a lower. Depending on the formula used, this midpoint line is usually a zero line. Some oscillators also have upper and lower boundaries, ranging from 0 to 100. General rules for interpretation. As a general rule, when the oscillator reaches an extreme value in either the upper or lower end of the band, this suggests that the current price move may have gone too far, too fast, and is due for a correction or consolidation of some type. As another general rule, the trader should be buying when the oscillator line is in the lower end of the band and selling in the upper end. The crossing of the midpoint line is often used to generate buy and sell signals. We'll see how these general rules are applied as we deal with the various types of oscillators. The three most important uses for the oscillator. There are three situations when the oscillator is most useful. You'll see that these three situations are common to most types of oscillators that are used. 1. The oscillator is most useful when its value reaches an extreme reading near the upper or lower end of its boundaries. The market is said to be overbought when it is near the upper extreme and oversold when it is near the lower extreme. This warns that the price trend is overextended and vulnerable. 2. A divergence between the oscillator and the price action when the oscillator is in an extreme position is usually an important warning. 3. The crossing of the zero or midpoint line can give important trading signals in the direction of the price trend. Measuring momentum. The concept of momentum is the most basic application of oscillator analysis. Momentum measures the velocity of price changes as opposed to the actual price levels themselves. Market momentum is measured by continually taking price differences for a fixed time interval. To construct a 10-day momentum line, simply subtract the closing price 10 days ago from the last closing price. This positive or negative value is then plotted around a zero line. The formula for momentum is M equals V, Vx, where V is the latest closing price and Vx is the closing price X days ago. If the latest closing price is greater than that of 10 days ago, in other words, prices have moved higher, then a positive value would be plotted above the zero line. If the latest close is below the close 10 days earlier, prices have declined, then a negative value is plotted below the zero line. While the 10-day momentum is a commonly used time period for reasons discussed later, any time period can be employed. See Figure 10.1a. A shorter time period, such as 5 days, produces a more sensitive line with more pronounced oscillations. A longer number of days, such as 40 days, results in a much smoother line in which the oscillator swings are less volatile. See Figure 10.1b. Momentum measures rates of ascent or descent. Let's talk a bit more about just what this momentum indicator is measuring. By plotting price differences for a set period of time, the chartist is studying rates of ascent or descent. If prices are rising and the momentum line is above the zero line and rising, this means the uptrend is accelerating. If the upslanting momentum line begins to flatten out, this means that the new gains being achieved by the latest closes are the same as the gains 10 days earlier. While prices may still be advancing, the rate of ascent, or the velocity, has leveled off. When the momentum line begins to drop toward the zero line, the uptrend in prices is still in force, but at a decelerating rate. The uptrend is losing momentum. When the momentum line moves below the zero line, the latest 10-day close is now under the close of 10 days ago, and a near-term downtrend is in effect. And, incidentally, the 10-day moving average also has begun to decline. As momentum continues to drop farther below the zero line, the downtrend gains momentum. Only when the line begins to advance again does the analyst know that the downtrend is decelerating. It's important to remember that momentum measures the differences between prices at 2 time intervals. In order for the line to advance, the price gains for the last day's close must be greater than the gains of 10 days ago. If prices advance by only the same amount as 10 days ago, the momentum line will be flat. If the last price gain is less than that of 10 days ago, the momentum line begins to decline, even though prices are still rising. This is how the momentum line measures the acceleration or deceleration in the current advance or decline in the price trend. The momentum line leads the price action. Because of the way it is constructed, the momentum line is always a step ahead of the price movement. It leads the advance or decline in prices, then levels off while the current price trend is still in effect. It then begins to move in the opposite direction as prices begin to level off. The crossing of the zero line as a trading signal. The momentum chart has a zero line. Many technicians use the crossing of the zero line to generate buy and sell signals. A crossing above the zero line would be a buy signal, and a crossing below the zero line a sell signal. It should be stressed here again, however, that basic trend analysis is still the overriding consideration. Oscillator analysis should not be used as an excuse to trade against the prevailing market trend. Buy positions should only be taken on crossings above the zero line if the market trend is up. Short positions should be taken on crossings below the zero line only if the price trend is down. See figures 10.2a and b. The need for an upper and lower boundary. One problem with the momentum line, as it is described here, is the absence of a fixed upper and lower boundary. It was stated earlier that one of the major values of oscillator analysis is being able to determine when markets are in extreme areas. But how high is too high and how low is too low on the momentum line? The simplest way to solve this problem is by visual inspection. Check the back history of the momentum line on the chart and draw horizontal lines along its upper and lower boundaries. These lines will have to be adjusted periodically, especially after important trend changes have occurred. But it is the simplest and probably the most effective way of identifying the outer extremities. See figures 10.3 and 10.4. Measuring rate of change, RO key. To measure the rate of change, a ratio is constructed of the most recent closing price to a price a certain number of days in the past. And to change. To construct a 10-day rate of change oscillator, the latest closing price is divided by the close 10 days ago. The formula is as follows. Rate of change equals 100 VVX, where V is the latest close and VX is the closing price X days ago. In this case, the 100 line becomes the midpoint line. If the latest price is higher than the price 10 days ago, prices are rising. The resulting rate of change value will be above 100. If the last close is below 10 days ago, the ratio would be below 100. Charting software sometimes uses variations of the preceding formulas for momentum and rate of change. While the construction techniques may vary, the interpretation remains the same. Constructing an oscillator using two moving averages. Chapter 9 discussed two moving averages being used to generate buy and sell signals. The crossing of the shorter average above or below the longer average registered buy and sell signals, respectively. It was mentioned at that time that these dual moving average combinations could also be used to construct oscillator charts. This can be done by plotting the difference between the two averages as a histogram. These histogram bars appear as a plus or minus value around a centered zero line. This type of oscillator has three uses. 1. To help spot divergences. 2. To help identify short-term variations from the long-term trend when the shorter average moves too far above or below the longer average. 3. To pinpoint the crossings of the two moving averages, which occur when the oscillator crosses the zero line. The shorter average is divided by the longer. In both cases, however, the shorter average oscillates around the longer average, which is in effect the zero line. If the shorter average is above the longer, the oscillator would be positive. A negative reading would be present if the shorter average were under the longer. See figures 10.5 to 10.7. When the two moving average lines move too far apart, a market extreme is created, calling for a pause in the trend. See figure 10.6. Very often, the trend remains stalled until the shorter average line moves back to the longer. When the shorter line approaches the longer, a critical point is reached. In an uptrend, for example, the shorter line dips back to the longer average, but should bounce off it. This usually represents an ideal buying area. It's much like the testing of an uptrend line. If the shorter average crosses below the longer average, however, a trend reversal is signaled. In a downtrend, a rise in the shorter average to the longer usually represents an ideal selling area unless the longer line is crossed, in which case a trend reversal signal would be registered. The relationships between the two averages can be used, therefore, not only as an excellent trend following system, but also to help identify short-term overbought and oversold conditions. Commodity Channel Index. It is possible to normalize an oscillator by dividing the values by a constant divisor. In the construction of his Commodity Channel Index, CCI, Donald R. Lambert compares the current price with a moving average over a selected time span, usually 20 days. He then normalizes the oscillator values by using a divisor based on mean deviation. As a result, the CCI fluctuates in a constant range, from plus 100 on the upside to minus 100 on the downside. Lambert recommended long positions in those markets with values over plus 100. Markets with CCI values below minus 100 were candidates for short sales. It seems, however, that most chartists use CCI simply as an overbought/oversold oscillator. Used in that fashion, readings over plus 100 are considered overbought and under minus 100 are oversold. While the Commodity Channel Index was originally developed for commodities, it is also used for trading stock index futures and options like the S&P 100 OEX. Although 20 days is the common default value for CCI, the user can vary the number to adjust its sensitivity. See figures 10.8 and 10.9. The Relative Strength Index, RSI. The RSI was developed by J. Wells Wilder Jr. and presented in his 1978 book, New Concepts in Technical Trading Systems. We're only going to cover the main points here. A reading of the original work by Wilder himself is recommended for a more in-depth treatment. Because this particular oscillator is so popular among traders, we'll use it to demonstrate most of the principles of oscillator analysis. As Wilder points out, one of the two major problems in constructing a momentum line using price differences is the erratic movement often caused by sharp changes in the values being dropped off. A sharp advance or a decline 10 days ago, in the case of a 10-day momentum line, can cause sudden shifts in the momentum line even if the current prices show little change. Some smoothing is therefore necessary to minimize these distortions. The second problem is that there is the need for a constant range for comparison purposes. The RSI formula not only provides the necessary smoothing, but also solves the latter problem by creating a constant vertical range of 0 to 100. The term relative strength, incidentally, is a misnomer and often causes confusion among those more familiar with that term, as it is used in stock market analysis. Relative strength generally means a ratio line comparing two different entities. A ratio of a stock or industry group to the S&P 500 index is one way of gauging the relative strength of different stocks or industry groups against one objective benchmark. We'll show you later in the book how useful relative strength or ratio analysis can be. Wilder's relative strength index doesn't really measure the relative strength between different entities, and in that sense, the name is somewhat misleading. The RSI, however, does solve the problem of erratic movement and the need for a constant upper and lower boundary. The actual formula is calculated as follows. 14 days are used in the calculation. 14 weeks are used for weekly charts. To find the average up value, add the total points gained on up days during the 14 days and divide that total by 14. To find the average down value, add the total number of points lost during the down days and divide that total by 14. Relative strength, RS, is then determined by dividing the up average by the down average. That RS value is then inserted into the formula for RSI. The number of days can be varied by simply changing the value of X. Wilder originally employed a 14-day period. The shorter the time period, the more sensitive the oscillator becomes and the wider its amplitude. RSI works best when its fluctuations reach the upper and lower extremes. Therefore, if the user is trading on a very short-term basis and wants the oscillator swings to be more pronounced, the time period can be shortened. The time period is lengthened to make the oscillator smoother and narrower in amplitude. The amplitude in the 9-day oscillator is therefore greater than the original 14-day. While 9 and 14-day spans are the most common values used, technicians experiment with other periods. Some use shorter lengths, such as 5 or 7 days, to increase the volatility of the RSI line. Others use 21 or 28 days to smooth out the RSI signals. See figures 10.10 and 10.11. Interpreting RSI. RSI is plotted on a vertical scale of 0 to 100. Movements above 70 are considered overbought, while an oversold condition would be a move under 30. Because of shifting that takes place in bull and bear markets, the 80 level usually becomes the overbought level in bull markets, and the 20 level the oversold level in bear markets. Failure swings, as Wilder calls them, occur when the RSI is above 70 or under 30. A top failure swing occurs when a peak in the RSI, over 70, fails to exceed a previous peak in an uptrend, followed by a downside break of a previous trough. A bottom failure swing occurs when the RSI is in a downtrend under 30, fails to set a new low, and then proceeds to exceed a previous peak. See figures 10.12 A to B. Divergence between the RSI and the price line when the RSI is above 70 or below 30 is a serious warning that should be heeded. Wilder himself considers divergence the single most indicative characteristic of the relative strength index. Wilder, page 70. Trendline analysis can be employed to detect changes in the trend of the RSI. Moving averages can also be used for the same purpose. See figure 10.13. In my own personal experience with the RSI oscillator, its greatest value lies in failure swings or divergences that occur when the RSI is over 70 or under 30. Let's clarify another important point on the use of oscillators. Any strong trend, either up or down, usually produces an extreme oscillator reading before too long. In such cases, claims that a market is overbought or oversold are usually premature and can lead to an early exit from a profitable trend. In strong uptrends, overbought markets can stay overbought for some time. Just because the oscillator has moved into the upper region is not reason enough to liquidate a long position, or, even worse, short into the strong uptrend. The first move into the overbought or oversold region is usually just a warning. The signal to pay close attention to is the second move by the oscillator into the danger zone. If the second move fails to confirm the price move into new highs or new lows, forming a double top or bottom on the oscillator, a possible divergence exists. At that point, some defensive action can be taken to protect existing positions. If the oscillator moves in the opposite direction, breaking a previous high or low, then a divergence or failure swing is confirmed. The 50 level is the RSI midpoint value and will often act as support during pullbacks and resistance during bounces. Some traders treat RSI crossings above and below the 50 level as buying and selling signals respectively. Using the 70 and 30 lines to generate signals, horizontal lines appear on the oscillator chart at the 70 and 30 values. Traders often use those lines to generate buy and sell signals. We already know that a move under 30 warns of an oversold conditions. Suppose the trader thinks a market is about to bottom and is looking for a buying opportunity. He or she watches the oscillator dip under 30. Some type of divergence or double bottom may develop in the oscillator in that oversold region. A crossing back above the 30 line at that point is taken by many traders as a confirmation that the trend in the oscillator has turned up. Accordingly, in an overbought market, a crossing back under the 70 line can often be used as a sell signal. See figure 10.14. Stochastics, K%D. The stochastic oscillator was popularized by George Lane, president of Investment Educators, Inc., Watseka, IL. It is based on the observation that as prices increase, closing prices tend to be closer to the upper end of the price range. Conversely, in downtrends, the closing price tends to be near the lower end of the range. Two lines are used in the stochastic process, the %K line and the %D line. The %D line is the more important and is the one that provides the major signals. The intent is to determine where the most recent closing price is in relation to the price range for a chosen time period. 14 is the most common period used for this oscillator. To determine the K line, which is the more sensitive of the two, the formula is %K equals 100 times C minus L14 divided by H14 minus L14. Where C is the latest close, L14 is the lowest low for the last 14 periods, and H14 is the highest high for the same 14 periods. 14 periods can refer to days, weeks, or months. The formula simply measures, on a percentage basis of 0 to 100, where the closing price is in relation to the total price range for a selected time period. A very high reading, over 80, would put the closing price near the top of the range, while a low reading, under 20, near the bottom of the range. The second line, %D, is a 3-period moving average of the %K line. This formula produces a version called fast stochastics. By taking another 3-period average of %D, a smoother version called slow stochastics is computed. Most traders use the slow stochastics because of its more reliable signals. These formulas produce two lines that oscillate between a vertical scale from 0 to 100. The K line is a faster line, while the D line is a slower line. The major signal to watch for is a divergence between the D line and the price of the underlying market market when the D-line is in an overbought or oversold area. The upper and lower extremes are the 80 and 20 values. See Figure 10.15. A bearish divergence occurs when the D-line is over 80 and forms two declining peaks while prices continue to move higher. A bullish divergence is present when the D-line is under 20 and forms two rising bottoms while prices continue to move lower. Assuming all of these factors are in place, the actual buy or sell signal is triggered when the faster K-line crosses the slower D-line. There are other refinements in the use of stochastics, but this explanation covers the more essential points. Despite the higher level of sophistication, the basic oscillator interpretation remains the same. An alert or setup is present when the percent D-line is in an extreme area and diverging from the price action. The actual signal takes place when the D-line is crossed by the faster K-line. The stochastic oscillator can be used on weekly and monthly charts for longer range perspective. It can also be used effectively on intraday charts for shorter-term trading. See Figure 10.16. One way to combine daily and weekly stochastics is to use weekly signals to determine market direction and daily signals for timing. It's also a good idea to combine stochastics with RSI. See Figure 10.17. Larry Williams %R. Larry Williams %R is based on a similar concept of measuring the latest close in relation to its price range over a given number of days. Today's close is subtracted from the price high of the range for a given number of days, and that difference is divided by the total range for the same period. The concepts already discussed for oscillator interpretation are applied to %R as well, with the main factors being the presence of divergences in overbought or oversold areas. See Figure 10.18. Since %R is subtracted from the high, it looks like an upside-down stochastics. To correct that, charting packages plot an inverted version of %R. Choice of time period tied to cycles. Oscillator lengths can be tied to underlying market cycles. A time period of 1/2 the cycle length is used. Popular time inputs are 5, 10, and 20 days, based on calendar day periods of 14, 28, and 56 days. Wilder's RSI uses 14 days, which is half of 28. In the previous chapter, we discussed some reasons why the numbers 5, 10, and 20 keep cropping up in moving average and oscillator formulations, so we won't repeat them here. Suffice it to mention here that 28 calendar days, 20 trading days, represent an important dominant monthly trading cycle, and that the other numbers are related harmonically to that monthly cycle. The popularity of the 10-day momentum and the 14-day RSI lengths are based largely on the 28-day trading cycle and measure 1/2 of the value of that dominant trading cycle. We'll come back to the importance of cycles in Chapter 14. The importance of trend. In this chapter, we've discussed the use of the oscillator in market analysis to help determine near-term overbought and oversold conditions and to alert traders to possible divergences. We started with the momentum line. We discussed another way to measure rates of change, ROC, by using price ratios instead of differences. We then showed how two moving averages could be compared to spot short-term extremes and crossovers. Finally, we looked at RSI and stochastics and considered how oscillators should be synchronized with cycles. Divergence analysis provides us with the oscillator's greatest value. However, the reader is cautioned against placing too much importance on divergence analysis to the point where basic trend analysis is either ignored or overlooked. Most oscillator buy signals work best in uptrends, and oscillator sell signals are most profitable in downtrends. The place to start your market analysis is always by determining the general trend of the market. If the trend is up, then a buying strategy is called for. Oscillators can then be used to help time market entry. Buy when the market is oversold in an uptrend, sell short when the market is overbought in a downtrend, or buy when the momentum oscillator crosses back above the zero line, when the major trend is bullish, and sell a crossing under the zero line in a bear market. The importance of trading in the direction of the major trend cannot be overstated. The danger in placing too much importance on oscillators by themselves is the temptation to use divergence as an excuse to initiate trades contrary to the general trend. This action generally proves a costly and painful exercise. The oscillator, as useful as it is just one tool among many others, and must always be used as an aid, not a substitute, for basic trend analysis. When oscillators are most useful. There are times when oscillators are more useful than at others. During choppy market periods, as prices move sideways for several weeks or months, Oscillators track the price movement very closely. The peaks and troughs on the price chart coincide almost exactly with the peaks and troughs on the oscillator. Because both price and oscillator are moving sideways, they look very much alike. At some point, however, a price breakout occurs, and a new uptrend or downtrend begins. By its very nature, the oscillator is already in an extreme position, just as the breakout is taking place. If the breakout is to the upside, the oscillator is already overbought. An oversold reading usually accompanies a downside breakout. The trader is faced with a dilemma. Should he or she buy the bullish breakout in the face of an overbought oscillator reading? Should the downside breakout be sold into an oversold market? In such cases, the oscillator is best ignored for the time being and the position taken. The reason for this is that in the early stages of a new trend, following an important breakout, oscillators often reach extremes very quickly and stay there for a while. Basic trend analysis should be the main consideration at such times, with oscillators given a lesser role. Later on, as the trend begins to mature, the oscillator should be given greater weight. We'll see in Chapter 13 that the fifth and final wave in Elliott wave analysis is often confirmed by bearish oscillator divergences. Many dynamic bull moves have been missed by traders who saw the major trend signal but decided to wait for their oscillators to move into an oversold condition before buying. To summarize, give less attention to the oscillator in the early stages of an important move, but pay close attention to its signals as the move reaches maturity. Moving Average Convergence Divergence (MACD). We mentioned in the previous chapter an oscillator technique that uses two exponential moving averages, and here it is. The Moving Average Convergence Divergence Indicator, or simply MACD, was developed by Gerald Appel. What makes this indicator so useful is that it combines some of the oscillator principles we've already explained with a dual moving average crossover approach. You'll see only 2 lines on your computer screen, although 3 lines are actually used in its calculation. The faster line, called the MACD line, is the difference between 2 exponentially smoothed moving averages of closing prices, usually the last 12 and 26 days or weeks. The slower line, called the signal line, is usually a 9-period exponentially smoothed average of the MACD line. Appel originally recommended one set of numbers for buy signals and another for sell signals. Most traders, however, utilize the default values of 12, 26, and 9 in all instances. That would include daily and weekly values. See Figure 10.19a. The actual buy and sell signals are given when the 2 lines cross. A crossing by the faster MACD line above the slower signal line is a buy signal. A crossing by the faster line below the slower is a sell signal. In that sense, MACD resembles a dual moving average crossover method. However, the MACD values also fluctuate above and below a zero line. That's where it begins to resemble an oscillator. An overbought condition is present when the lines are too far above the zero line. An oversold condition is present when the lines are too far below the zero line. The best buy signals are given when prices are well below the zero line, oversold. Crossings above and below the zero line are another way to generate buy and sell signals respectively, similar to the momentum technique we discussed previously. Divergences appear between the trend of the MACD lines and the price line. A negative or bearish divergence exists when the MACD lines are well above the zero line, overbought, and start to weaken while prices continue to trend higher. That is often a warning of a market top. A positive or bullish divergence exists when the MACD lines are well below the zero line, oversold, and start to move up ahead of the price line. That is often an early sign of a market bottom. Simple trend lines can be drawn on the MACD lines to help identify important trend changes. See Figure 10.19b. MACD histogram. We showed you earlier in the chapter how a histogram could be constructed that plots the difference between 2 moving average lines. Using that same technique, the 2 MACD lines can be turned into an MACD histogram. The histogram consists of vertical bars that show the difference between the 2 MACD lines. The histogram has a zero line of its own. When the MACD lines are in positive alignment, faster line over the slower, the histogram is above its zero line. Crossings by the histogram above and below its zero line coincided with actual MACD crossover buy and sell signals. The real value of the histogram is spotting, when the spread between the 2 lines is widening or narrowing. When the histogram is over its zero line, positive, but starts to fall toward the zero line, the uptrend is weakening. Conversely, when the histogram is below its zero line, negative, and starts to move upward toward the zero line, the downtrend is losing its momentum. Although no actual buy or sell signal is given until the histogram crosses its zero line, the histogram turns provide earlier warnings that the current trend is losing momentum. Turns in the histogram back toward the zero line always precede the actual crossover signals. Histogram turns are best used for spotting early exit signals from existing positions. It's much more dangerous to use the histogram turns as an excuse to initiate new positions against the prevailing trend. See Figure 10.20a. Combine weeklies and dailies. As with all technical indicators, signals on weekly charts are always more important than those on daily charts. The best way to combine them is to use weekly signals to determine market direction and the daily signals to fine-tune entry and exit points. A daily signal is followed only when it agrees with the weekly signal. Used in that fashion, the weekly signals become trend filters for daily signals. That prevents using daily signals to trade against the prevailing trend. Two crossover systems in which this principle is especially true are MACD and stochastics. See Figure 10.20b. The principle of contrary opinion in futures. Oscillator analysis is the study of market extremes. One of the most widely followed theories in measuring those market extremes is the principle of contrary opinion. At the beginning of the book, two principal philosophies of market analysis were identified: fundamental and technical analysis. Contrary opinion, although it is generally listed under the category of technical analysis, is more aptly described as a form of psychological analysis. Contrary opinion adds the important third dimension to market analysis, the psychological, by determining the degree of bullishness or bearishness among participants in the various financial markets. The principle of contrary opinion holds that when the vast majority of people agree on anything, they are generally wrong. A true contrarian, therefore, will first try to determine what the majority are doing, and then will act in the opposite direction. Humphrey B. Neal, considered the dean of contrary thinking, described his theories in a 1954 book entitled The Art of Contrary Thinking. 10 years later, in 1964, James H. Sibbett began to apply Neal's principles to commodity futures trading by creating the Market Vein Advisory Service, which includes the bullish consensus numbers. Market Vein, P.O. Box 90490, Pasadena, California 91109. Each week, a poll of market letters is taken to determine the degree of bullishness or bearishness among commodity professionals. The purpose of the poll is to quantify market sentiment into a set of numbers that can be analyzed and used in the market forecasting process. The rationale behind this approach is that most futures traders are influenced to a great extent by market advisory services. By monitoring the views of the professional market letters, therefore, a reasonably accurate gauge of the attitudes of the trading public can be obtained. Another service that provides an indication of market sentiment is the Consensus Index of Bullish Market Opinion, published by Consensus National Commodity Futures Weekly. Consensus Inc., 1735 McGee Street, Kansas City, Missouri, 64108. These numbers are published each Friday and use 75% as an overbought and 25% as an oversold measurement. Interpreting bullish consensus numbers. Most traders seem to employ a fairly simple method of analyzing these weekly numbers. If the numbers are above 75%, the market is considered to be overbought and means that a top may be near. A reading below 25% is interpreted to warn of an oversold condition and the increased likelihood that a market bottom is near. Contrary opinion measures remaining buying or selling power. Consider the case of an individual speculator. Assume that speculator reads his or her favorite newsletter and becomes convinced that a market is about to move substantially higher. The more bullish the forecast, the more aggressively that trader will approach the market. Once that individual speculator's funds are fully committed to that particular market, however, he or she is overbought, meaning there are no more funds to commit to the market. Expanding this situation to include all market participants, if 80 to 90% of market traders are bullish on a market, it is assumed that they have already taken their market positions. Who is left to buy and push the market higher? This, then, is one of the keys to understanding contrary opinion. If the overwhelming sentiment of market traders is on one side of the market, there simply isn't enough buying or selling pressure left to continue the present trend. Contrary opinion measures strong versus weak hands. A second feature of this philosophy is its ability to compare strong versus weak hands. Futures trading is a zero-sum game. For every long, there is also a short. If 80% of the traders are on the long side of a market, then the remaining 20%, who are holding short positions, must be well financed enough to absorb the longs held by the other 80%. The shorts, therefore, must be holding much larger positions than the longs, in this case 4-to-1. This means further that the shorts must be well capitalized and are considered to be strong hands. The 80% who are holding much smaller positions per trader are considered to be weaker hands, who will be forced to liquidate those longs on any sudden turn in prices. Some additional features of the bullish consensus numbers. Let's consider a few additional points that should be kept in mind when using these numbers. And the norm or equilibrium point is at 55%. This allows for a built-in bullish bias on the part of the general public. The upper extreme is considered to be 90%, and the lower extreme 20%. Here again, the numbers are shifted upward slightly to allow for the bullish bias. A contrarian position can usually be considered when the bullish consensus numbers are above 90% or under 20%. Readings over 75% or under 25% are also considered warning zones and suggest that a turn may be near. However, it is generally advisable to await a change in the trend of the numbers before taking action against the trend. A change in the direction of the bullish consensus numbers, especially if it occurs from one of the danger zones, should be watched closely. The importance of open interest futures. Open interest also plays a role in the use of bullish consensus numbers. In general, the higher the open interest figures are, the better the chance that the contrarian positions will prove profitable. A contrarian position should not be taken, however, while open interest is still increasing. A continued rise in open interest numbers increases the odds that the present trend will continue. Wait for the open interest numbers to begin to flatten out or to decline before taking action. Study the Commitments of Traders report to ensure that hedgers hold less than 50% of the open interest. Contrary opinion works better when most of the open interest is held by speculators, who are considered to be weaker hands. It is not advisable to trade against large hedging interests. Watch the market's reaction to fundamental news. Watch the market's reaction to fundamental news very closely. The failure of prices to react to bullish news in an overbought area is a clear warning that a turn may be near. The first adverse news is usually enough to quickly push prices in the other direction. Correspondingly, the failure of prices in an oversold area, under 25%, to react to bearish news can be taken as a warning that all the bad news has been fully discounted in the current low price. Any bullish news will push prices higher. Combine contrarian opinion with other technical tools. As a general rule, trade in the same direction as the trend of the consensus numbers until an extreme is reached, at which time the numbers should be monitored for a sign of a change in trend. It goes without saying that standard technical analytical tools can and should also be employed to help identify market turns at these critical times. The breaking of support or resistance levels, trend lines, or moving averages can be utilized to help confirm that the trend is in fact turning. Divergences on oscillator charts are especially useful when the bullish consensus numbers are overbought or oversold. Investor sentiment readings. Each weekend, Barron's includes in its market laboratory section a set of numbers under the heading Investor Sentiment Readings. In that space, 4 different investor polls are included to gauge the degree of bullishness and bearishness in the stock market. The figures are given for the latest week and the period 2 and 3 weeks back for comparison purposes. Here's a random sample of what the latest week's figures might look like. Remember that these numbers are contrary indicators. Too much bullishness is bad. Too much bearishness is good. Investors' intelligence numbers. Investors' Intelligence, 30 Church Street, New Rochelle, New York, 10801, takes a weekly poll of investment advisors and produces 3 numbers: the percent of investment advisors that are bullish, those that are bearish, and those that are expecting a market correction. Bullish readings over 55% warn of too much optimism and are potentially negative for the market. Bullish readings below 35% reflect too much pessimism and are considered positive for the market. The correction figure represents advisors who are bullish but expecting short-term weakness. Investors' Intelligence also publishes figures each week that measure the number of stocks that are above their 10 and 30-week moving averages. Those numbers can also be used in a contrary fashion. Readings above 70% suggest an overbought stock market. Readings below 30% suggest an oversold market. The 10-week readings are useful for measuring short to intermediate market turns. The 30-week numbers are more useful for measuring major market turns. The actual signal of a potential change in trend takes place when the numbers rise back above 30 or fall back below 70. The second smoothing produces 3 lines. Fast stochastics uses the first 2 lines. Slow stochastics uses the last 2 lines. End of Chapter 10.
Chapter 11, Point and Figure. Introduction. The first charting technique used by stock market traders before the turn of the century was point and figure charting. The actual name, point and figure, has been attributed to Victor de Villiers in his 1933 classic, The Point and Figure Method of Anticipating Stock Price Movements. The technique has had various names over the years. In the 1880s and 1890s, it was known as the book method. This was the name Charles Dow gave it in a July 20th, 1901 editorial of the Wall Street Journal. Dow indicated that the book method had been used for about 15 years, giving it a starting date of 1886. The name figure charts was used from the 1920s until 1933, when point and figure became the accepted name for this technique of tracking market movement. R.D. Wyckoff also published several works dealing with the point and figure method in the early 1930s. The Wall Street Journal started publishing daily high, low, and closing stock prices in 1896, which is the first reference to the more commonly known bar chart. Therefore, it appears that the point and figure method predates bar charting by at least 10 years. We're going to approach point and figure charting in 2 steps. We'll look at the original method that relies on intraday price moves. Then we'll show you a simpler version of point and figure charting that can be constructed by using only the high and low prices for any market. An important difference is the treatment of volume. Bar charts record volume bars under the day's price action. Point and figure charts ignore volume numbers as a separate entity. This last phrase, as a separate entity, is an important one. Although the volume numbers are not recorded on the point and figure chart, it does not necessarily follow that volume or trading activity is totally lost. On the contrary, since intraday point and figure charts record all price change activity, the heavier or lighter volume is reflected in the amount of price changes recorded on the chart. Because volume is one of the more important ingredients in determining the potency of support and resistance levels, point and figure charts become especially useful in determining at which price levels most of the trading activity took place, and hence where the important support and resistance numbers are. Figure 11.1 compares a bar chart and a point and figure chart covering the same time span. In one sense, the charts look similar, but in another sense, quite different. The general price and trend picture is captured on both charts, but the method of recording prices is different. Notice in Figure 11.2 the alternating columns of X's and O's. The X columns represent rising prices, while the O columns show declining prices. Each time a column of X's moves one box above a previous column of X's, an upside breakout occurs. See arrows in Figure 11.2. Correspondingly, when a column of O's declines one box under a previous column of O's, a downside breakout occurs. Notice how much more precise these breakouts are than those on the bar chart. These breakouts can, of course, be used as buy and sell signals. We'll have more to say on buy and sell signals a bit later. But the charts demonstrate one of the advantages of the point and figure chart, mainly the greater precision and ease in recognizing trend signals. Figures 11.3 and 11.4 reveal another major advantage of the point and figure chart, flexibility. While all 3 of the P&F charts cover the same price action, we can make them look very different to serve different purposes. One way to change the P&F chart is to vary the reversal criteria, let's say from a 3-box reversal to a 5-box reversal. The larger the number of boxes required for a reversal, the less sensitive the chart becomes. The second way to vary the chart is to change the box size. Figure 2 uses a box size of 5 points. Figure 11.3 changes the box size from 5 points to 10 points. The number of columns has been reduced from 44 in the 5.3 chart in Figure 11.2 to only 16 columns in Figure 11.3. By using the larger box size in Figure 11.3, fewer signals are given. That allows the investor to concentrate on the major trend of a market by avoiding all the short-term sell signals that are eliminated from the less sensitive chart. Figure 11.4 reduces the box size from 5 to 3. That increases the sensitivity of the chart. Why would anyone want to do that? Because it's better for shorter-term trading. Compare the last rally from 920 to 1060 in all 3 charts. The 10.3 chart, Figure 11.3, shows the last column as a series of X's with no O columns. The 5.3 chart, Figure 11.2, shows the last up leg in 5 columns, 3 X columns and 2 O columns. The 3x3 chart, Figure 11.4, breaks the last up leg into 11 columns, 6 X columns and 5 O columns. By increasing the number of corrections during the uptrend, by increasing the number of O columns, more repeat buy signals are given either for later entry or for adding to winning positions. It also allows the trader to raise protective sell stops below the latest columns of O's. The bottom line is that you can alter the look of the point and figure chart to adjust its sensitivity to suit your own needs. Construction of the intraday point and figure chart. We've already stated that the intraday chart was the original type used by point and figure chartists. The technique was originally used to track stock market movement. The intent was to capture and record on paper each 1-point move of the stocks under consideration. It was felt that accumulation, buying, and distribution, selling, could be better detected in this manner. Only whole numbers were employed. Each box was given a value of 1 point, and each 1-point move in either direction was recorded. Fractions were largely ignored. When the technique was later adopted to commodity markets, the value of the box had to be adjusted to fit each different commodity market. Let's construct an intraday chart using some actual price data. The following numbers describe 9 actual days of trading in a Swiss franc futures contract. The box size is 5 points. Therefore, every 5-point swing in either direction is plotted. We'll start with a 1-box reversal chart. Figure 11.5a is what the previously listed numbers would look like on the chart. Let's begin on the left side of the chart. First, the chart is scaled to reflect a 5-point increment for every box. Column 1, put a dot at 48.75. Because the next number, 48.80, is higher, fill in the next box up to 48.80. Column 2, the next number is 48.60. Move 1 column to the right, go down 1 box, and fill in all the O's down to 48.60. Column 3, the next number is 48.65. Move 1 column to the right, move up 1 box, and put an X at 48.65. Stop here. You have a 1X marked in column 3 because prices have only moved up 1 box. On a 1-box reversal chart, there must always be at least 2 boxes filled in each column. Notice that the next number is 48.50, calling for O's down to that number. Do you go to the next column to record the column of declining O's? The answer is no, because that would leave only 1 mark, the X, in column 3. Therefore, in the column with the lone X, column 3, fill in O's down to 48.50. Column 4, the next number is 48.60. Move to the next column, move 1 box up, and plot in the X's up to 48.60. Column 5, the next number is 48.55. Because this is a move down, go to the next column, move down a box, and fill the O at 48.60. Notice on the table that this is the last price of the day. Let's do one more. Column 6, the first number on 5 packs is 48.70. So far, you only have 1 O in column 5. You must have at least 2 marks in each column. Therefore, fill in X's because prices are advancing up to 48.70. But notice that the last price on the previous day is blacked out. This is to help keep track of time. By blacking in the last price each day, it's much easier to keep track of the separate days trading. Feel free to continue through the remainder of the chart to sharpen your understanding of the plotting process. Notice that this chart has several columns where both X's and O's are present. This situation will only develop on the 1-point reversal chart and is caused by the necessity of having at least 2 boxes filled in each column. Some purists might argue with combining the X's and O's. Experience will show, however, that this method of plotting prices makes it much easier to follow the order of the transactions. Figure 11.5b takes the same data from Figure 11.5a and transforms it into a 3-box reversal chart. Notice that the chart is condensed and a lot of data is lost. Figure 11.5c shows a 5-box reversal. These are the 3 reversal criteria that have traditionally been used: the 1, 3, and 5-box reversal. The 1-box reversal is generally used for very short-term activity, and the 3-box for the study of the intermediate trend. The 5-box reversal, because of its severe condensation, is generally used for the study of long-term trends. The correct order to use is the one shown here. That is, begin with the 1-point reversal chart. The 3 and 5-box reversals can then be constructed right off the first chart. For obvious reasons, a 1-point reversal chart could not possibly be constructed from a 3 or 5-box reversal. The horizontal count. One principal advantage of the intraday 1-box reversal chart is the ability to obtain price objectives through use of the horizontal count. If you think back to our coverage of bar charts and price patterns, the question of price objectives was discussed. However, virtually all methods of obtaining price objectives off bar charts were based on what we call vertical measurements. This meant measuring the height of a pattern, the volatility, and projecting that distance upward or downward. For example, the head and shoulders pattern measured the distance from the head to the neckline and swung that objective from the break of that neckline. Point and figure charts allow horizontal measurement. The principle of the horizontal count is based on the premise that there is a direct relationship between the width of a congestion area and the subsequent move once a breakout occurs. If the congestion area represents a basing pattern, some estimate can be made of the upside potential once the base is completed. Once the uptrend has begun, subsequent congestion areas can be used to obtain additional counts, which can be utilized to confirm the original counts from the base. See Figure 11.6. The intent is to measure the width of the pattern. Remember, we're talking here of intraday one-box reversal charts. The technique requires some modifications for other types of charts that we'll come back to later. Once a topping or basing area has been identified, simply count the number of columns in that top or base. If there are 20 columns, for example, the upside or downside target would be 20 boxes from the measuring point. The key is to determine which line to measure from. Sometimes this is easy and, at other times, more difficult. Usually, the horizontal line to count across is near the middle of the congestion area. A more precise rule is to use the line that has the least number of empty boxes in it, or put the other way, the line with the most number of filled-in X's and O's. Once you find the correct line to count across, it's important that you include every column in your count, even the ones that are empty. Count the number of columns in the congestion area, and then project that number up or down from the line that was used for the count. Price patterns. Pattern identification is also possible on point and figure charts. Figure 11.7 shows the most common types. As you can see, they're not much different from ones already discussed on bar charting. Most of the patterns are variations on the double and triple tops and bottoms, head and shoulders, V's and inverted V's, and saucers. The term fulcrum shows up quite a bit in the point and figure literature. Essentially, the fulcrum is a well-defined congestion area occurring after a significant advance or decline that forms an accumulation base or a distribution top. In a base, for example, the bottom of the area is subjected to repeated tests, interrupted by intermittent rally attempts. Very often, the fulcrum takes on the appearance of a double or triple bottom. The basing pattern is completed when a breakout, catapult, occurs over the top of the congestion area. Those reversal patterns with the most pronounced horizontal ranges obviously lend themselves quite well to the taking of count measurements. The V-base, in contrast, because of the absence of a significant horizontal price area, would not be amenable to the taking of a horizontal count. The blackened boxes in the chart examples in Figure 11.7 represent suggested buying and selling points. Notice that those entry points generally coincide with the retesting of support areas in a base or resistance areas in a top breakout points and the breaking of trend lines. Trend analysis and trend lines. The price patterns in Figure 11.7 show trend lines drawn as part of those patterns. Trend line analysis on intraday charts is the same as that applied to bar charts. Up trend lines are drawn under successive lows, and down trend lines are drawn over successive peaks. This is not true of the simplified point and figure chart, which we're going to study next. It utilizes 45-degree lines and plots them differently. 3-box reversal point and figure charting. In 1947, a book on point and figure was written by A.W. Cohen entitled Stock Market Timing. The following year, when the Chartcraft weekly service was started, the book's name was changed to The Chartcraft Method of Point and Figure Trading. Several revised editions have been published since then to include commodities and options. In 1990, Michael Burke wrote the all-new guide to the three-point reversal method of point and figure construction and formations, Chartcraft, New Rochelle, NY. The original one-box reversal method of plotting markets required intraday prices. The 3-box reversal was a condensation of the 1-box and was meant for intermediate trend analysis. Cohen reasoned that because so few 3-box reversals occurred in stocks during the day, it was not necessary to use intraday prices to construct the 3-box reversal chart. Hence the decision to use only the high and low prices, which were readily available in most financial newspapers. This modified technique, which is the basis of the Chartcraft service, greatly simplified point and figure charting and made it accessible to the average trader. Construction of the 3-point reversal chart. The construction of the chart is relatively simple. First, the chart must be scaled in the same way as the intraday chart. A value must be assigned to each box. These tasks are performed for subscribers to the Chartcraft service because the charts are already constructed and the box values assigned. The chart shows a series of alternating columns with X's representing rising prices and the O columns showing falling prices. See Figure 11.8. The actual plotting of the X's and O's requires only the high and low prices for the day. If the last column is an X column showing rising prices, then look at the high price for the day. If the daily high permits the filling in of one or more X's, then fill in those boxes and stop. That's all you do for that day. Remember that the entire value of the box must be filled. Fractions or partial filling of the box don't count. Repeat the same process the next day, looking only at the high price. As long as prices continue to rise, permitting the plotting of at least one X, continue to fill in the boxes with X's, ignoring the low price. The day finally comes when the daily high price is not high enough to fill the next X box. At that point, look at the low price to determine if a 3-box reversal has occurred in the other direction. If so, move one column to the right, move down one box, and fill the next 3 boxes with O's to signify a new down column. Because you are now in a down column, the next day consult the low price to see if that column of O's can be continued. If one or more O's can be filled in, then do so. Only when the daily low does not permit the filling in of any more O's do you look at the daily high to see if a 3-box reversal has occurred to the upside. If so, move one column to the right and begin a new X column. Chart patterns. Figure 11.9 shows 16 price patterns most common to this type of point and figure chart, 8 buy signals and 8 sell signals. Let's take a look at the patterns. Since column 2, showing signals S1 through S8, is just a mirror image of column 1, we'll concentrate on the buy side. The first 2 signals, B1 and B2, are simple formations. All that is required for the simple bullish buy signal is 3 columns, with the second column of X's moving one box above the previous column of X's. B2 is similar to B1 with one minor difference. There are now 4 columns, with the bottom of the second column of O's higher than the first. B1 shows a simple breakout through resistance. B2 shows the same bullish breakout, but with the added bullish feature of rising bottoms. B2 is a slightly stronger pattern than B1 for that reason. The third pattern, B3, breakout of a triple top, begins the complex formations. Notice that the simple bullish buy signal is a part of each complex formation. Also, as we move down the page, these formations become increasingly stronger. The triple top breakout is stronger because there are 5 columns involved and 2 columns of X's have been penetrated. Remember that the wider the base, the greater the upside potential. The next pattern, B4, ascending triple top, is stronger than B3 because the tops and bottoms are both ascending. The spread triple top, B5, is even stronger because there are 7 columns involved and 3 columns of X's are exceeded. The upside breakout above a bullish triangle, B6, combines 2 signals. First, a simple buy signal must be present. Then the upper trend line must be cleared. We'll cover the drawing of trend lines on these charts in the next section. Signal B7, upside breakout above a bullish resistance line, is self-explanatory. Again, 2 things must be present. A buy signal must have already been given, and the upper channel line must be completely cleared. The final pattern, the upside breakout above a bearish resistance line, B8, also requires 2 elements. A simple buy signal must be combined with a clearing of the downtrend line. Of course, everything we've said regarding patterns B1 through B8 applies equally to patterns S1 through S8, except that, in the latter case, prices are headed down instead of up. There is a difference between how these patterns are applied to commodity markets as opposed to common stocks. In general, all 16 signals can be used in stock market trading. However, because of the rapid movement so characteristic of the futures markets, the complex patterns are not as common in the commodity markets. Much greater emphasis is therefore placed on the simple signals. Many futures traders utilize the simple signals alone. If the trader chooses to wait for the more complex and stronger patterns, many profitable trading opportunities will be missed. The drawing of trend lines. In our discussion of intraday charts, it was pointed out that trend lines were drawn in the conventional way. This is not the case on these 3-point reversal charts. Trend lines on these charts are drawn at 45-degree angles. Also, trend lines do not necessarily have to connect previous tops or bottoms. the basic bullish support line and bearish resistance line. These are your basic up and down trend lines. Because of the severe condensation on these charts, it would be impractical to try to connect rally tops or reaction lows. The 45-degree line is, therefore, used. In an uptrend, the bullish support line is drawn at a 45-degree angle upward to the right from under the lowest column of O's. As long as prices remain above that line, the major trend is considered to be bullish. In a downtrend, the bearish resistance line is drawn at a 45-degree angle downward to the right from the top of the highest column of X's. As long as prices remain below that downtrend line, the trend is bearish. See figures 11.10 to 11.12. At times, those lines may have to be adjusted. For example, sometimes a correction in an uptrend breaks below the rising support line, after which the uptrend resumes. In such cases, a new support line must be drawn at a 45-degree angle from the bottom of that reaction low. Sometimes a trend is so strong that the original uptrend line is simply too far away from the price action. In that case, a tighter trend line should be drawn in an attempt to arrive at a best-fitting support line. Measuring techniques. 3-point reversal charts allow the use of two different measuring techniques, the horizontal and the vertical. For the horizontal, count the number of columns in a bottom or topping pattern. That number of columns must then be multiplied by the value of the reversal or the number of boxes needed for a reversal. For example, let's assign a $1 box value to a chart with a 3-box reversal. We count the number of boxes across a base and come up with 10. Because we're using a 3-box reversal, the value of that reversal is $3. 3 buys $1. Multiply the 10 columns across the base by $3 for a total of $30. That number is then added to the bottom of the basing pattern or subtracted from the top of a topping pattern to arrive at the price objective. The vertical count is a bit simpler. Measure the number of boxes in the first column of the new trend. In an uptrend, measure the first up column of X's. In a downtrend, measure the first down column of O's. Multiply that value by 3 and add that total to the bottom or subtract it from the top of the column. What you're doing in effect with a 3-box reversal chart is tripling the size of the first leg. If a double top or bottom occurs on the chart, use the second column of O's or X's for the vertical count. See figure 11.12. Trading tactics. Let's look at the various ways that these point and figure charts can be used to determine specific entry and exit points. 1. A simple buy signal can be used for the covering of old shorts and/or the initiation of new longs. 2. A simple sell signal can be used for the liquidation of old longs and/or the initiation of new shorts. 3. The simple signal can be used only for liquidation purposes with a complex formation needed for a new commitment. 4. The trend line can be used as a filter. Long positions are taken above the trend line and short positions below the trend line. 5. For stop protection, always risk below the last column of O's in an uptrend and over the last column of X's in a downtrend. 6. The actual entry point can be varied as follows. A. Buy the actual breakout in an uptrend. B. Buy a 3-box reversal after the breakout occurs to obtain a lower entry point. C. Buy a 3-box reversal in the direction of the original breakout after a correction occurs. Not only does this require the added confirmation of a positive reversal in the right direction, but a closer stop point can now be used under the latest column of O's. D. Buy a second breakout in the same direction as the original breakout signal. As you can readily see from the list, there are many different ways that the point and figure chart can be used. Once the basic technique is understood, there is almost unlimited flexibility as to how to best enter and exit a market using this approach. Adjusting stops. The actual buy or sell signal occurs on the first signal. However, as the move continues, several other signals appear on the chart. These repeat buy or sell signals can be used for additional positions. Whether or not this is done, the protective stop point can be raised to just below the latest O column in an uptrend and lowered to just over the latest X column in a downtrend. This use of a trailing stop allows the trader to stay with the position and protect accumulated profits at the same time. What to do after a prolonged move. Intermittent corrections against the trend allow the trader to adjust stops once the trend has resumed. How is this accomplished, however? If no 3-box reversals occur during the trend, the trader is then faced with a long column of X's in an uptrend or O's in a downtrend. This type of market situation creates what is called a pole, that is, a long column of X's and O's without a correction. The trader wants to stay with the trend, but also wants some technique to protect profits. There is at least one way to accomplish this. After an uninterrupted move of 10 or more boxes, place a protective stop at the point where a 3-box reversal would occur. If the position does get stopped out, re-entry can be done on another 3-box reversal in the direction of the original trend. In that case, an added advantage is the placement of the new stop under the most recent column of O's in an uptrend or over the latest column of X's in a downtrend. Advantages of point and figure charts. Let's briefly recap some of the advantages of point and figure charting. 1. By varying the box and reversal sizes, these charts can be adapted to almost any need. There are also many different ways these charts can be used for entry and exit points. 2. Trading signals are more precise on point and figure charts than on bar charts. 3. By following these specific point and figure signals, better trading discipline can be achieved. See Figures 11.13-11.18. P&F Technical Indicators. In his 1995 book, Point and Figure Charting, John Wiley & Sons, Thomas J. Dorsey espouses the Chartcraft method of 3-point reversal charting of stocks. He also discusses point and figure application to commodity and options trading. In addition to explaining how to construct and read the charts, Dorsey also shows how the P&F technique can be applied to relative strength analysis, sector analysis, and in the construction of an NYSE bullish percent index. He shows how P&F charts can be constructed for the NYSE Advanced Decline Line, the NYSE High-Low Index, and the percentage of stocks over their 10 and 30-week averages. Dorsey credits Michael Burke, the publisher of Chartcraft, Chartcraft Inc., Investors Intelligence, 30 Church Street, New Rochelle, NY 10801, with the actual development of these innovative P&F indicators, which are available in that chart service. Computerized P&F charting. Computers have taken the drudgery out of point and figure charting. The days of laboriously constructing columns of X's and O's are gone. Most charting software packages do the charting for you. In addition, you can vary the box and reversal sizes with a keystroke to adjust the chart for shorter or longer-term analysis. You can construct P&F charts from real-time intraday and end-of-day data, and you can apply them to any market you want. But you can do a lot more with a computer. Kenneth Tower, CMT, technical analyst for UST Securities Corporation, 5 Vaughan Drive, CN 5209, Princeton NJ 08543, uses a logarithmic method of point and figure charting. A screening process that measures the volatility of a stock over the last 3 years determines the right percentage box size for each stock. Figures 11.19 and 11.20 show examples of Tower's logarithmic P&F charts applied to America Online and Intel. The box size for AOL in Figure 11.19 is 3.6%. A 1-box reversal, therefore, would require a retracement of 3.6%. Since that happens to be a 2-box reversal chart, prices would have to retrace 7.2% to start a new column. Each box size for the Intel chart shown in Figure 11.20 is worth 3.2%. The arcs you see on both charts are examples of using horizontal price counts across a price base to arrive at short and long-term price objectives. The Intel chart, for example, shows a short-term objective to 33, arrived at by measuring halfway across the price base, lower arc. The larger arc, which measures to 87.6, is arrived at by measuring across the entire price base and projecting that distance upward. If you look closely at Figures 11.19 and 11.20, you'll also see price dots trailing the price action. Those dots happen to be moving averages. P&F moving averages. Moving averages are usually applied to bar charts, but here they are on point and figure charts, courtesy of Ken Tower and UST Securities. Tower uses 2 moving averages on his charts, a 10-column and a 20-column moving average. The dots you see in Figures 11.19 and 11.20 are 10-column averages. These moving averages are constructed by first finding an average price for each column. That is done by simply adding up the prices in each column and dividing the total by the number of X's or O's in that column. The resulting numbers are then averaged over 10 and 20 columns. The moving averages are used in the same way as on bar charts. Figure 11.21 shows 2 point and figure charts of the same stock with 10-column averages, dots, and 20-column averages, dashes. The bottom chart is a 2.7% reversal logarithmic chart of Royal Dutch Petroleum going back to 1992. Notice that the faster moving average stayed above the slower moving average from 1993 to 1997 during the 4-year uptrend. You can see the two moving averages coming together during the second half of 1997 in what turned out to be a consolidation year for that stock. To the far right, you can see that Royal Dutch may be on the verge of resuming its major uptrend. A closer look at that potential upside breakout is seen in the upper chart in figure 11.21. The upper chart is a traditional one-point reversal linear chart of the same stock. The time frame covered in the linear chart is much shorter than the long chart, but you get a closer look at the late 1997 and early 1998 price action and can see the short-term upside breakout at the start of 1998. The stock still needs to close through 60 to confirm a major bullish breakout. The moving averages haven't been much help during the trading range. They never are, but should begin to trend higher once again if the bullish breakout materializes. By adding moving averages to point and figure charts, Ken Tower brings another valuable technical indicator to P&F charting. The use of logarithmic charts also adds a modern wrinkle to this old charting method. Conclusion: point and figure charting isn't the oldest technique in the world. That credit goes to the Japanese candlestick chart, which has been used in that country for centuries. In the next chapter, Greg Morris, author of 2 books on candlesticks, will introduce that ancient technique that has gained new popularity in recent years among Western technical analysts. End of Chapter 11. Chapter 12, Japanese Candlesticks. Introduction. While the Japanese have used this charting and analysis technique for centuries, only in recent years has it become popular in the West. The term, candlesticks, actually refers to 2 different but related subjects. First, and possibly the more popular, is the method of displaying stock and futures data for chart analysis. Secondly, it is the art of identifying certain combinations of candlesticks in defined and proven combinations. Fortunately, both techniques can be used independently or in combination. Candlestick charting. Charting market data in candlestick form uses the same data available for standard bar charts: open, high, low, and close prices. While using the exact same data, candlestick charts offer a much more visually appealing chart. Information seems to jump off the page, computer screen. The information displayed is more easily interpreted and analyzed. The box below is a depiction of a single day of prices showing the difference between the bar, left, and the candlesticks. See figure 12.1. You can see how the name candlesticks came about. They look somewhat like a candle with a wick. The rectangle represents the difference between the open and close price for the day and is called the body. Notice that the body can be either black or white. A white body means that the close price was greater, higher than the open price. Actually, the body is not white, but open, not filled, which makes it work better with computers. This is so that it will print correctly when printing charts on a computer. This is one of the adaptations that have occurred in the West. The Japanese use red for the open body. The black body means that the close price was lower than the open price. The open and close prices are given much significance in Japanese candlesticks. The small lines above and below the body are referred to as wicks or hairs or shadows. Many different names for these lines appear in Japanese reference literature, which is odd since they represent the high and low prices for the day and are normally not considered vital in the analysis by the Japanese. See figure 12.2. Figure 12.2 shows the same data in both the popular bar chart and in a Japanese candlestick format. You can quickly see that information not readily available on the bar chart seems to jump from the page, screen, on the candlestick chart. Initially, it takes some getting used to, but after a while, you may prefer it. The different shapes for candlesticks have different meanings. The Japanese have defined different primary candlesticks based upon the relationship of open, high, low, and close prices. Understanding these basic candlesticks is the beginning of candlestick analysis. Basic candlesticks. Different body shadow combinations have different meanings. Days in which the difference between the open and close prices is great are called long days. Likewise, days in which the difference between the open and close price is small are called short days. Remember, we are only talking about the size of the body and no reference is made to the high and or low prices. See figure 12.3. Spinning tops are days in which the candlesticks have small bodies with upper and lower shadows that are of greater length than that of the body. The body color is relatively unimportant in spinning top candlesticks. These candlesticks are considered as days of indecision. See figure 12.4. When the open price and the close price are equal, they are called doji lines. Doji candlesticks can have shadows of varying length. When referring to doji candlesticks, there is some consideration as to whether the open and close price must be exactly equal. This is a time when the prices must be almost equal, especially when dealing with large price movements. There are different doji candlesticks that are important. The long-leg doji has long upper and lower shadows and reflects considerable indecision on the part of market participants. The gravestone doji has only a long upper shadow and no lower shadow. The longer the upper shadow, the more bearish the interpretation. The dragonfly doji is the opposite of the gravestone doji. The lower shadow is long and there is no upper shadow. It is usually considered quite bullish. See Figure 12.5. The single candlestick lines are essential to Japanese candlestick analysis. You will find that all Japanese candle patterns are made from combinations of these basic candlesticks. Candle pattern analysis. A Japanese candle pattern is a psychological depiction of traders' mentality at the time. It vividly shows the actions of the traders as time unfolds in the market. The mere fact that humans react consistently during similar situations makes candle pattern analysis work. A Japanese candle pattern can consist of a single candlestick line or be a combination of multiple lines, normally never more than 5. While most candle patterns are used to determine reversal points in the market, there are a few that are used to determine trend continuation. They are referred to as reversal and continuation patterns. Whenever a reversal pattern has bullish implications, an inversely related pattern has bearish meaning. Similarly, whenever a continuation pattern has bullish implications, an opposite pattern gives bearish meaning. When there is a pair of patterns that work in both bullish and bearish situations, they usually have the same name. In a few cases, however, the bullish pattern and its bearish counterpart have completely different names. Reversal patterns. A reversal candle pattern is a combination of Japanese candlesticks that normally indicate a reversal of the trend. One serious consideration that must be used to help identify patterns as being either bullish or bearish is the trend of the market preceding the pattern. You cannot have a bullish reversal pattern in an uptrend. You can have a series of candlesticks that resemble the bullish pattern. But if the trend is up, it is not a bullish Japanese candle pattern. Likewise, you cannot have a bearish reversal candle pattern in a downtrend. This presents one of the age-old problems when analyzing markets. What is the trend? You must determine the trend before you can utilize Japanese candle patterns effectively. While volumes have been written on the subject of trend determination, the use of a moving average will work quite well with Japanese candle patterns. Once the short-term, 10 periods or so trend has been determined, Japanese candle patterns will significantly assist in identifying the reversal of that trend. Japanese literature consistently refers to approximately 40 reversal candle patterns. These vary from single candlestick lines to more complex patterns of up to 5 candlestick lines. There are many good references on candlesticks, so only a few of the more popular patterns will be discussed here. Dark cloud cover. This is a 2-day reversal pattern that only has bearish implications. See Figure 12.6. This is also one of the times when the pattern's counterpart exists but has a different name. See piercing line. The first day of this pattern is a long white candlestick. This reflects the current trend of the market and helps confirm the uptrend to traders. The next day opens above the high price of the previous day, again adding to the bullishness. However, trading for the rest of the day is lower, with a close price at least below the midpoint of the body of the first day. This is a significant blow to the bullish mentality and will force many to exit the market. Since the close price is below the open price on the second day, the body is black. This is the dark cloud referred to in the name, piercing line. The opposite of the dark cloud cover, the piercing line, has bullish implications. See Figure 12.7. The scenario is quite similar, but opposite. A downtrend is in place. The first candlestick is a long black day, which solidifies traders' confidence in the downtrend. The next day, prices open at a new low and then trade higher all day and close above the midpoint of the first candlestick's body. This offers a significant change to the downtrend mentality, and many will reverse or exit their positions. Evening star and morning star. The evening star and its cousin, the morning star, are two powerful reversal candle patterns. These are both 3-day patterns that work exceptionally well. The scenario for understanding the change in trader psychology for the evening star will be thoroughly discussed here, since the opposite can be said for the morning star. See Figures 12.8 and 12.9. The evening star is a bearish reversal candle pattern, as its name suggests. The first day of this pattern is a long white candlestick that fully enforces the current uptrend. On the open of the second day, prices gap up above the body of the first day. Trading on this second day is somewhat restricted, and the close price is near the open price while remaining above the body of the first day. The body for the second day is small. This type of day following a long day is referred to as a star pattern. A star is a small body day that gaps away from a long body day. The third and last day of this pattern opens with a gap below the body of the star and closes lower, with the close price below the midpoint of the first day. The previous explanation was the perfect scenario. Many references will accept as valid an evening star that does not meet each detail exactly. For instance, the third day might not gap down, or the close on the third day might not be quite below the midpoint of the first day's body. These details are subjective when viewing a candlestick chart, but not when using a computer program to automatically identify the patterns. That is because computer programs require explicit instructions to read the candle chart and don't allow for subjective interpretation. Continuation patterns. Each trading day, a decision needs to be made, whether it is to exit a trade, enter a trade, or remain in a trade. A candle pattern that helps identify the fact that the current trend is going to continue is more valuable than may first appear. It helps answer the question as to whether or not you should remain in a trade. Japanese literature refers to 16 continuation candle patterns. One continuation pattern and its related opposite cousin are particularly good at trend continuation identification. Rising and falling three methods. The rising three methods continuation candle pattern is the bullish counterpart to this duo and will be the subject of this scenario building. A bullish continuation pattern can only occur in an uptrend, and a bearish continuation pattern can only occur in a downtrend. This restates the required relationship to the trend that is so necessary in candle pattern analysis. See figures 12.10 and 12.11. The first day of the rising three methods pattern is a long white day which fully supports the uptrending market. However, over the course of the next three trading periods, small body days occur which, as a group, trend downward. They all remain within the range of the first day's long white body, and at least two of these three small-bodied days have black bodies. This period of time when the market appears to have gone nowhere is considered by the Japanese as a period of rest. On the fifth day of this pattern, another long white day develops which closes at a new high. Prices have finally broken out of the short trading range and the uptrend will continue. A 5-day pattern, such as the rising three methods, requires a lot of detail in its definition. The above scenario is the perfect example of the rising three methods pattern. Flexibility can be applied with some success, and this only comes with experience. For example, the three small reaction days could remain within the first day's high-low range instead of the body's range. The small reaction days do not always have to be predominantly black. And finally, the concept of the period of rest could be expanded to include more than 3 reaction days. Don't ignore the rising and falling three methods pattern. It can give you a feeling of comfort when worrying about protecting profits in a trade. Using computers for candle pattern identification. A personal computer with software designed to recognize candle patterns is a great way to remove emotion, especially during a trade. However, there are a couple of things to keep in mind when viewing candlesticks on a computer screen. A computer screen is made up of small light elements called pixels. There are only so many pixels on your computer screen, with the amount based upon the resolution of your video card/monitor combination. If you are viewing price data that has a large range of prices in a short period of time, you may think that you are seeing many doji days. Open and close price are equal, when in fact, you are not. With a large range of prices on the screen, each pixel element will have a price range of its own. A computer software program that identifies patterns based on a mathematical relationship will overcome this visual anomaly. Hopefully, the above explanation will keep you from thinking that your software isn't working. Filtered candle patterns. A revolutionary concept developed by Greg Morris in 1991, called candle pattern filtering, provides a simple method to improve the overall reliability of candle patterns. While the short-term trend of the market must be identified before a candle pattern can exist, determination of overbought and oversold markets using traditional technical analysis will enhance a candle pattern's predictive ability. Concurrently, this technique helps eliminate bad or premature candle patterns. One must first grasp how a traditional technical indicator responds to price data. In this example, stochastic cent D will be used. The stochastic indicator oscillates between 0 and 100, with 20 being oversold and 80 being overbought. The primary interpretation for this indicator is when cent D rises above 80 and then falls below 80, a sell signal has been generated. Similarly, when it drops below 20 and then rises above 20, a buy signal is given. See Chapter 10 for more on stochastics. Here is what we know about stochastic cent D. When it enters the area above 80 or below 20, it will eventually generate a signal. In other words, it is just a matter of time until a signal is given. The area above 80 and below 20 is called the presignal area and represents the area that cent D must get to before it can give a trading signal of its own. See Figure 12.12. The filtered candle pattern concept uses this presignal area. Candle patterns are considered only when cent D is in its presignal area. If a candle pattern occurs when stochastic cent D is at, say, 65, the pattern is ignored. Also, only reversal candle patterns are considered using this concept. Candle pattern filtering is not limited to using stochastic cent D. Any technical oscillator that you might normally use for analysis can be used to filter candle patterns. Wilder's RSI, Lambert's CCI, and Williams' Ascent R are a few that will work equally as well. These oscillators are explained in Chapter 10. SOST Conclusion. Japanese candlestick charting and candle pattern analysis are essential tools for making market timing decisions. One should use Japanese candle patterns in the same manner as any other technical tool or technique. That is, to study the psychology of market participants. Once you become used to seeing your price charts using candlesticks, you may not want to use bar charts again. Japanese candle patterns, used in conjunction with other technical indicators in the filtering concept, will almost always offer a trading signal prior to using other price-based indicators. Chapter 13, Elliott Wave Theory. Historical background. In 1938, a monograph entitled The Wave Principle was the first published reference to what has come to be known as the Elliott Wave Principle. The monograph was published by Charles J. Collins and was based on the original work presented to him by the founder of the Wave Principle, Ralph Nelson, R.N. Elliott. Elliott was very much influenced by the Dow theory, which has much in common with the Wave Principle. In a 1934 letter to Collins, Elliott mentioned that he had been a subscriber to Robert Rea's stock market service and was familiar with Rea's book on Dow theory. Elliott goes on to say that the Wave Principle was a much-needed complement to the Dow theory. In 1946, just 2 years before his death, Elliott wrote his definitive work on the Wave Principle, Nature's Law, The Secret of the Universe. Elliott's ideas might have faded from memory if A. Hamilton Bolton hadn't decided in 1953 to publish the Elliott Wave Supplement to the Bank Credit Analyst, which he did annually for 14 years until his death in 1967. A.J. Frost took over the Elliott Supplements and collaborated with Robert Prechter in 1978 on the Elliott Wave Principle. Most of the diagrams in this chapter are taken from Frost and Prechter's book. Prechter went a step further and in 1980 published the major works of R.N. Elliott, making available the original Elliott writings that had long been out of print. Basic tenets of the Elliott Wave Principle. There are 3 important aspects of wave theory: pattern, ratio, and time, in that order of importance. Pattern refers to the wave patterns or formations that comprise the most important element of the theory. Ratio analysis is useful in determining retracement points and price objectives by measuring the relationships between the different waves. Finally, time relationships also exist and can be used to confirm the wave patterns and ratios, but are considered by some Elliottians to be less reliable in market forecasting. Elliott wave theory was originally applied to the major stock market averages, particularly the Dow Jones Industrial Average. In its most basic form, the theory says that the stock market follows a repetitive rhythm of a 5-wave advance, followed by a 3-wave decline. Figure 13.1 shows one complete cycle. If you count the waves, you will find that one complete cycle has 8 waves, 5 up and 3 down. In the advancing portion of the cycle, notice that each of the 5 waves is numbered. Waves 1, 3, and 5, called impulse waves, are rising waves, while waves 2 and 4 move against the uptrend. Waves 2 and 4 are called corrective waves because they correct waves 1 and 3. After the 5-wave numbered advance has been completed, a 3-wave correction begins. The 3 corrective waves are identified by the letters A, B, C. Along with the constant form of the various waves, there is the important consideration of degree. There are many different degrees of trend. Elliott, in fact, categorized 9 different degrees of trend, or magnitude, ranging from a grand supercycle spanning 200 years to a subminuet degree covering only a few hours. The point to remember is that the basic 8-wave cycle remains constant no matter what degree of trend is being studied. Each wave subdivides into waves of one lesser degree that, in turn, can also be subdivided into waves of even lesser degree. It also follows, then, that each wave is itself part of the wave of the next higher degree. Figure 13.2 demonstrates these relationships. The largest 2 waves, 1 and 2, can be subdivided into 8 lesser waves that, in turn, can be subdivided into 34 even lesser waves. The 2 largest waves, 1 and 2, are only the first 2 waves in an even larger 5-wave advance. Wave 3 of that next higher degree is about to begin. The 34 waves in figure 13.2 are subdivided further to the next smaller degree in figure 13.3, resulting in 144 waves. The numbers shown so far, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, are not just random numbers. They are part of the Fibonacci number sequence, which forms the mathematical basis for the Elliott wave theory. We'll come back to them a little later. For now, look at figures 13.1-13.3 and notice a very significant characteristic of the waves. Whether a given wave divides into 5 waves or 3 waves is determined by the direction of the next larger wave. For example, in figure 13.2, waves 1, 3, and 5 subdivide into 5 waves because the next larger wave of which they are part, wave 1, is an advancing wave. Because waves 2 and 4 are moving against the trend, they subdivide into only 3 waves. Look more closely at corrective waves A, B, and C, which comprise the larger corrective wave 2. Notice that the 2 declining waves, A and C, each break down into 5 waves. This is because they are moving in the same direction as the next larger wave 2. Wave B, by contrast, only has 3 waves because it is moving against the next larger wave 2. Being able to determine between 3s and 5s is obviously of tremendous importance in the application of this approach. That information tells the analyst what to expect next. A completed 5-wave move, for example, usually means that only part of a larger wave has been completed and that there's more to come, unless it's a fifth of a fifth. One of the most important rules to remember is that a correction can never take place in 5 waves. In a bull market, for example, if a 5-wave decline is seen, this means that it is probably only the first wave of a 3-wave ABC decline, and that there's more to come on the downside. In a bear market, a 3-wave advance should be followed by resumption of the downtrend. A 5-wave rally would warn of a more substantial move to the upside and might possibly even be the first wave of a new bull trend. Connection between Elliott wave and Dow theory. Let's take a moment here to point out the obvious connection between Elliott's idea of 5 advancing waves and Dow's 3 advancing phases of a bull market. It seems clear that Elliott's idea of 3 up waves with 2 intervening corrections fits nicely with the Dow theory. While Elliott was no doubt influenced by Dow's analysis, it also seems clear that Elliott believed he had gone well beyond Dow's theory and had in fact improved on it. It's also interesting to note the influence of the sea on both men in the formulation of their theories. Dow compared the major, intermediate, and minor trends in the market with the tides, waves, and ripples on the ocean. Elliott referred to ebbs and flows in his writing and named his theory the wave principle. Corrective waves. So far, we've talked mainly about the impulse waves in the direction of the major trend. Let's turn our attention now to the corrective waves. In general, corrective waves are less clearly defined and, as a result, tend to be more difficult to identify and predict. One point that is clearly defined, however, is that corrective waves can never take place in 5 waves. Corrective waves are 3s, never 5s, with the exception of triangles. We're going to look at 3 classifications of corrective waves: zigzags, flats, and triangles. Zigzags. A zigzag is a three-wave corrective pattern against the major trend, which breaks down into a 5-3-5 sequence. Figures 13.4 and 13.5 show a bull market zigzag correction, while a bear market rally is shown in figures 13.6 and 13.7. Notice that the middle wave B falls short of the beginning of wave A, and that wave C moves well beyond the end of wave A. A less common variation of the zigzag is the double zigzag shown in figure 13.8. This variation sometimes occurs in larger corrective patterns. It is, in effect, two different 5-3-5 zigzag patterns connected by an intervening ABC pattern, flats. What distinguishes the flat correction from the zigzag correction is that the flat follows a 3-3-5 pattern. Notice in figures 13.10 and 13.112 that the A wave is a 3 instead of a 5. In general, the flat is more of a consolidation than a correction and is considered a sign of strength in a bull market. Figures 13.9 to 13.112 show examples of normal flats. In a bull market, for example, wave B rallies all the way to the top of wave A, showing greater market strength. The final wave C terminates at or just below the bottom of wave A, in contrast to a zigzag, which moves well under that point. There are two irregular variations of the normal flat correction. Figures 13.13.16 show the first type of variation. Notice in the bull market example, figures 13.13 and 13.14, that the top of wave B exceeds the top of A, and that wave C violates the bottom of A. Another variation occurs when wave B reaches the top of A, but wave C fails to reach the bottom of A. Naturally, this last pattern denotes greater market strength in a bull market. This variation is shown in figures 13.17.20 for bull and bear markets. Triangles. Triangles usually occur in the fourth wave and precede the final move in the direction of the major trend. They can also appear in the B wave of an AABC correction. In an uptrend, therefore, it can be said that triangles are both bullish and bearish. They're bullish in the sense that they indicate resumption of the uptrend. They're bearish because they also indicate that after one more wave up, prices will probably peak. See figure 13.21. Elliott's interpretation of the triangle parallels the classical use of the pattern, but with his usual added precision. Remember from chapter 6 that the triangle is usually a continuation pattern, which is exactly what Elliott said. Elliott's triangle is a sideways consolidation pattern that breaks down into 5 waves, each wave in turn having 3 waves of its own. Elliott also classifies 4 different kinds of triangles: ascending, descending, symmetrical, and expanding, all of which were seen in chapter 6. Figure 13.21 shows the 4 varieties in both uptrends and downtrends. Because chart patterns in commodity futures contracts sometimes don't form as fully as they do in the stock market, it is not unusual for triangles in the futures markets to have only 3 waves instead of 5. Remember, however, that the minimum requirement for a triangle is still 4 points, 2 upper and 2 lower, to allow the drawing of 2 converging trend lines. Elliott wave theory also holds that the 5th and last wave within the triangle sometimes breaks its trend line, giving a false signal before beginning its thrust in the original direction. Elliott's measurement for the 5th and final wave after completion of the triangle is essentially the same as in classical charting. That is, the market is expected to move the distance that matches the widest part of the triangle, its height. There is another point worth noting here concerning the timing of the final top or bottom. According to Prechter, the apex of the triangle, the point where the 2 converging trend lines meet, often marks the timing for the completion of the final 5th wave, the rule of alternation. In its more general application, this rule or principle holds that the market usually doesn't act the same way 2 times in a row. If a certain type of top or bottom occurred the last time around, it will probably not do so again this time. The rule of alternation doesn't tell us exactly what will happen, but tells us what probably won't. In its more specific application, it is most generally used to tell us what type of corrective pattern to expect. Corrective patterns tend to alternate. In other words, if corrective wave 2 was a simple ABC pattern, wave 4 will probably be a complex pattern, such as a triangle. Conversely, if wave 2 is complex, wave 4 will probably be simple. Figure 13.22 gives some examples. Channeling. Another important aspect of wave theory is the use of price channels. You'll recall that we covered trend channeling in chapter 4. Elliott used price channels as a method of arriving at price objectives, and also to help confirm the completion of wave counts. Once an uptrend has been established, an initial trend channel is constructed by drawing a basic uptrend line along the bottoms of waves 1 and 2. A parallel channel line is then drawn over the top of wave 1, as shown in figure 13.23. The entire uptrend will often stay within those two boundaries. If wave 3 begins to accelerate to the point that it exceeds the upper channel line, the lines have to be redrawn along the top of wave 1 and the bottom of wave 2, as shown in figure 13.23. The final channel is drawn under the two corrective waves, 2 and 4, and usually above the top of wave 3, as shown in figure 13.24. If wave 3 is unusually strong or an extended wave, the upper line may have to be drawn over the top of wave 1. The fifth wave should come close to the upper channel line before terminating. For the drawing of channel lines on long-term trends, it's recommended that semi-log charts be employed along with arithmetic charts. Wave 4 as a support area. In concluding our discussion of wave formations and guidelines, one important point remains to be mentioned, and that is the significance of wave 4 as a support area in subsequent bear markets. Once 5 up waves have been completed and a bear trend has begun, that bear market will usually not move below the previous 4th wave of one lesser degree. That is, the last 4th wave that was formed during the previous bull advance. There are exceptions to that rule, but usually the bottom of the 4th wave contains the bear market. This piece of information can prove very useful in arriving at a maximum downside price objective. Fibonacci numbers as the basis of the wave principle. Elliott stated in Nature's Law that the mathematical basis for his wave principle was a number sequence discovered by Leonardo Fibonacci in the 13th century. That number sequence has become identified with its discoverer and is commonly referred to as the Fibonacci numbers. The number sequence is 1, 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, and so on to infinity. The sequence has a number of interesting properties, not the least of which is an almost constant relationship between the numbers. 1. The sum of any two consecutive numbers equals the next higher number. For example, 3 and 5 equals 8, 5 and 8 equals 13, and so on. 2. The ratio of any number to its next higher number approaches 0.618 after the first 4 numbers. For example, 1 1 is 1.00, 1 half is 0.50, 2/3 is 0.67, 3/5 is 0.60, 5/8 is in 625, 8/13 is 0.615, 13/21 is 0.619, and so on. Notice how these early ratio values fluctuate above and below 0.618 in narrowing amplitude. Also, notice the values of 1.00, 50, 0.67. We'll comment further on these values when we talk more about ratio analysis and percentage retracements. Number 3. The ratio of any number to its next lower number is approximately 1.618, or the inverse of 0.618. For example, 13/8 is 1.625, 21/13 is 1.615, 34/21 is 1.619. The higher the numbers become, the closer they come to the values of 0.618 and 1.618. 4. The ratios of alternate numbers approach 2.618 or its inverse, 0.382. For example, 1334 is 0.32, 34/13 is 2.615. Fibonacci ratios and retracements. It was already stated that wave theory is comprised of 3 aspects: waveform, ratio, and time. We've already discussed waveform, which is the most important of the 3. Let's talk now about the application of the Fibonacci ratios and retracements. These relationships can apply to both price and time, although the former is considered to be the more reliable. We'll come back later to the aspect of time. First of all, a glance back at figures 13.1 and 13.3 shows that the basic waveform always breaks down into Fibonacci numbers. One complete cycle comprises 8 waves, 5 up and 3 down, all Fibonacci numbers. 2 further subdivisions will produce 34 and 144 waves, also Fibonacci numbers. The mathematical basis of the wave theory on the Fibonacci sequence, however, goes beyond just wave counting. There's also the question of proportional relationships between the different waves. The following are among the most commonly used Fibonacci ratios. 1. One of the 3 impulse waves sometimes extends. The other 2 are equal in time and magnitude. If wave 5 extends, waves 1 and 3 should be about equal. If wave 3 extends, waves 1 and 5 tend toward equality. 2. A minimum target for the top of wave 3 can be obtained by multiplying the length of wave 1 by 1.6188 and adding that total to the bottom of 2. 3. The top of wave 5 can be approximated by multiplying wave 1 by 3.236 to 1.618 and adding that value to the top or bottom of wave 1 for maximum and minimum targets. 4. Where waves 1 and 3 are about equal and wave 5 is expected to extend, a price objective can be obtained by measuring the distance from the bottom of wave 1 to the top of wave 3, multiplying by 1.618 and adding the result to the bottom of 4.5. For corrective waves, in a normal 5-3-5 zigzag correction, wave C is often about equal to the length of wave A. 6. Another way to measure the possible length of wave C is to multiply 0.618 by the length of wave A and subtract that result from the bottom of wave A. 7. In the case of a flat 3-3-5 correction, where the B wave reaches or exceeds the top of wave A, wave C will be about 1.618 the length of A. 8. In a symmetrical triangle, each successive wave is related to its previous wave by about 0.618. Fibonacci percentage retracements. The preceding ratios help to determine price objectives in both impulse and corrective waves. Another way to determine price objectives is by the use of percentage retracements. The most commonly used numbers in retracement analysis are 61.8%, usually rounded off to 62%, 38%, and 50%. Remember from Chapter 4 that markets usually retrace previous moves by certain predictable percentages, the best known ones being 33%, 50%, and 67%. The Fibonacci sequence refines those numbers a bit further. In a strong trend, a minimum retracement is usually around 38%. In a weaker trend, the maximum percentage retracement is usually 62%. See figures 13.25 and 13.26. It was pointed out earlier that the Fibonacci ratios approach 0.618 only after the first four numbers. The first three ratios are 1/1, 100%, 1/2, 50%, and 2/3, 66%. Many students of Elliott may be unaware that the famous 50% retracement is actually a Fibonacci ratio, as is the 2/3 retracement. A complete retracement 100% of a previous bull or bear market also should mark an important support or resistance area. Fibonacci time targets. We haven't said too much about the aspect of time in wave analysis. Fibonacci time relationships exist. It's just that they're harder to predict and are considered by some Elliottians to be the least important of the three aspects of the theory. Fibonacci time targets are found by counting forward from significant tops and bottoms. On a daily chart, the analyst counts forward the number of trading days from an important turning point, with the expectation that future tops or bottoms will occur on Fibonacci days, that is, on the 13th, 21st, 34th, 55th, or 89th trading day in the future. The same technique can be used on weekly, monthly, or even yearly charts. On the weekly chart, the analyst picks a significant top or bottom and looks for weekly time targets that fall on Fibonacci numbers. See figures 13.27 and 13.28, combining all three aspects of wave theory. The ideal situation occurs when waveform, ratio analysis, and time targets come together. Suppose that a study of waves reveals that a fifth wave has been completed, that wave 5 has gone 1.618 times the distance from the bottom of wave 1 to the top of wave 3, and that the time from the beginning of the trend has been 13 weeks from a previous low and 34 weeks from a previous top. Suppose further that the fifth wave has lasted 21 days. Odds would be pretty good that an important top was near. A study of price charts in both stocks and futures markets reveals a number of Fibonacci time relationships. Part of the problem, however, is the variety of possible relationships. Fibonacci time targets can be taken from top to top to bottom to bottom, and bottom to top. These relationships can always be found after the fact. It's not always clear which of the possible relationships are relevant to the current trend. Elliott wave applied to stocks versus commodities. There are some differences in applying wave theory to stocks and commodities. For example, wave 3 tends to extend in stocks and wave 5 in commodities. The unbreakable rule that wave 4 can never overlap wave 1 in stocks is not as rigid in commodities. Intraday penetrations can occur on futures charts. Sometimes charts of the cash market in commodities give a clearer Elliott pattern than the futures market. The use of continuation charts in commodity futures markets also produces distortions that may affect long-term Elliott patterns. Possibly the most significant difference between the two areas is that major bull markets in commodities can be contained, meaning that bull market highs do not always exceed previous bull market highs. It is possible in commodity markets for a completed 5-wave bull trend to fall short of a previous bull market high. The major tops formed in many commodity markets in the 1980 to 1981 period failed to exceed major tops formed 7 and 8 years earlier. As a final comparison between the two areas, it appears that the best Elliott patterns in commodity markets arise from breakouts from long-term extended bases. It is important to keep in mind that wave theory was originally meant to be applied to the stock market averages. It doesn't work as well in individual common stocks. It's quite possible that it doesn't work that well in some of the more thinly traded futures markets as well, because mass psychology is one of the important foundations on which the theory rests. Gold, as an illustration, is an excellent vehicle for wave analysis because of its wide following. Summary and conclusions. Let's briefly summarize the more important elements of wave theory and then try to put it into proper perspective. 1. A complete bull market cycle is made up of 8 waves, 5 up waves followed by 3 down waves. 2. A trend divides into 5 waves in the direction of the next longer trend. 3. Corrections always take place in 3 waves. 4. The 2 types of simple corrections are zigzags, 5 to 3-5, and flats, 3-3-5. 5. Triangles are usually 4th waves and always precede the final wave. Triangles can also be B-corrective waves. 6. Waves can be expanded into longer waves and subdivided into shorter waves. 7. Sometimes one of the impulse waves extends. The other 2 should then be equal in time and magnitude. 8. The Fibonacci sequence is the mathematical basis of the Elliott wave theory. 9. The number of waves follows the Fibonacci sequence. 10. Fibonacci ratios and retracements are used to determine price objectives. The most common retracements are 62%, 50%, and 38%. 11. The rule of alternation warns not to expect the same thing twice in succession. 12. Bear markets should not fall below the bottom of the previous 4th wave. 13. Wave 4 should not overlap wave 1, not as rigid in futures. 14. The Elliott wave theory is comprised of waveforms, ratios, and time, in that order of importance. 15. The theory was originally applied to stock market averages and does not work as well on individual stocks. 16. The theory works best in those commodity markets with the largest public following, such as gold. 17. The principal difference in commodities is the existence of contained bull markets. The Elliott wave principle builds on the more classical approaches, such as Dow theory and traditional chart patterns. Most of those price patterns can be explained as part of the Elliott wave structure. It builds on the concept of swing objectives by using Fibonacci ratio projections and percentage retracements. The Elliott wave principle takes all of these factors into consideration, but goes beyond them by giving them more order and increased predictability. Wave theory should be used in conjunction with other technical tools. There are times when Elliott pictures are clear and other times when they are not. Trying to force unclear market action into an Elliott format and ignoring other technical tools in the process is a misuse of the theory. The key is to view Elliott wave theory as a partial answer to the puzzle of market forecasting. Using it in conjunction with all of the other technical theories in this book will increase its value and improve your chances for success. End of chapter 13.
That's it for this video. Thanks for watching, and don't forget to like and subscribe for more updates and insights.